We've never been very good at trimming and adding, and if we're right about buying the long-term compounding machines we want to buy, it doesn't make much difference. In general, we think a lot of trading around positions overvalues what you think you can know. Christopher Davis, Davis Advisors. It's just very hard to trade in and out of positions successfully over the long term. It's only possible when you can have unusually high confidence in the position of your intrinsic value estimate. The most common reason we sell is when we find a better opportunity. That naturally takes us out of some higher-valued stocks that might be most prone to a correction. Brian Bears, Bears Capital. We try to take a page from the Weizmann Institute, a leading scientific research center based in Israel. Weizmann has a world-class reputation as a result of their having the largest patent and royalty stream of any academic institution in the world. If you talk to the scientists there, they believe very strongly that their success comes from being able to do their work without having to worry about how their science will translate to commercial profit, even though in the end it quite often does. By focusing on long-term goals, they eliminate day-to-day distractions and are more likely to work through problems that inevitably arise. We want to have a similar mindset. We know our investors are going to worry about their portfolios over short time periods, but we explain to them that we won't. We try to look at short-term market gyrations as nothing more than opportunities to smartly enter or exit a position, subject to valuation and fundamentals. Stephen Romick, First Pacific Advisors. We practice the Taoist Wei Wu Wei, the doing, not doing, as regards our portfolio. We are mostly inert when it comes to shuffling the portfolio around, with turnover that is averaged in the 15 to 20% range. Many funds have turnover in excess of 100% per year as they constantly react to events or try to take advantage of short-term price moves. We usually do neither. We believe successful investing involves anticipating change, not reacting to it. Bill Miller, Legg Mason Funds. We're constitutionally set up to be inactive, following the Warren Buffett idea that you should always judge how you're doing in any given year relative to if you've done nothing. As long as we've made good decisions and our investment cases are intact, that creates a bias for inactivity. Don Noon, VN Capital. One lesson born of experience is that the best course in investing is often to do nothing. Given the propensity most of us have for tinkering, that's a hard lesson to apply in practice. Edward Studzinski, Harris Associates. We have a 5-year average holding period. Particularly in a volatile market like today's, people are trying to zig and zag ahead of every market turn that they're hoping they can forecast with scientific precision. We like to plant seeds and then watch the trees grow, and our portfolio is often a kind of portrait of inactivity. That's kept us from making sharp and sometimes emotional moves that we eventually come to regret. Matthew McLennan, First Eagle Funds. We set an upside target for each holding, which is not the maximum expectation we have, but the level at which we reasonably expect to be able to sell in the future. When we're right, we'll generally hold until the shares reach that upside. The reality is that we can't do the level of due diligence we want on each idea, and also turn the portfolio over quickly by constantly trading out good ideas for better ones. So we typically hold companies an average of 5 years. Stephen Romick, First Pacific Advisors. We believe the most important contributor to the long-term investment performance of the companies we own is earnings growth, not a change in valuation. Because growth is driven by earnings high returns on capital and successfully reinvesting cash flow, we tend to be very long-term investors. Our average holding period runs about 7 years in order for this virtuous process to bear fruit. Eric Endy, First Pacific Advisors. To compound returns at a high rate over a long time, it's going to happen because a relatively small number of your stocks go up massively. If we're right on the long-term trends, our bias is to stay with a trade for many years to allow that to happen. We try to avoid getting itchy every time something hits a new high. A stock that goes up a lot over time, by definition, is frequently hitting new highs. John Burbank, Passport Capital. Given the tax implications of selling, the cost of trading, and the challenge of getting 2 appraisals right, John Templeton used to have what he called the 100% rule, meaning the upside should be at least twice as high before swapping out one position for what you consider a more attractive one. We similarly want to improve our position materially when we trade an undervalued business. Mason Hawkins, Southeastern Asset Management. It's always been fairly easy for me to stay focused on the long term, but with 30 years' experience reinforcing the importance of that, it's easier to stay patient. In 2008, that patience didn't serve me so well. When the problem started to get attention, conviction that things would be fine in the medium to long term kept me from trying to time the cycle. In the short term, a lot more selling would have been a good idea. Hopefully that was a 1 in 50-year event. Robert Rabati, Rabati & Company. Buy and hold shouldn't really be a part of a value investor's vocabulary. All we know is price and value. If price meets value, whether in 3 months or 3 years, there's no justification for just sitting there. Charles DeVoe, International Value Advisors. One thing I learned from Tiger Management's Julian Robertson is the concept that there are no holds. Every day you're either willing to buy more at the current price, or if you aren't, you should redeploy the capital to something you believe does deserve incremental capital. I sometimes hear, if my target price is $45, why would we sell at $43? The answer is simple. I believe we have better uses for that capital than getting the last few percentage points in the move from $43 to $45. We distribute every day something we call the Sheet of Shame. It shows our 10 largest losses, cumulatively from the inception of the position, year to date, month to date, and yesterday. It's a way of focusing our attention on what's not working. There are only 2 ways to get something off the Sheet of Shame, which people are eager to do. Either eliminate the position, or increase the position and be right, earning some of those losses back. Lee Ainslie, Maverick Capital. We're paid to measure risk and reward, but evaluating risk and reward is a continuous process, not once a year or once a month. So our percentage holdings of names in our portfolio will run up and down based on relative attractiveness. For example, we may love stock A as a long-term investment. We buy it at the start of the year at $30, and within less than a year, it's up 50%. We're just as excited about the 3 to 5 year prospects today as we were. In fact, probably more so because we've seen that our thesis is on track. But the growth isn't at as reasonable a price now. So in a company like this that we know well, we think it's right by our investors to buy low and sell high as often as possible. It's hard work, and we run up trading costs, but we believe over time it dampens volatility and adds return. And that's our job. Larry Robbins, Glenview Capital. We've taken a more active view since 2008 on adjusting position sizes so they best reflect our level of conviction and return expectations. We're not at all becoming market timers, but we're much less apt today to let a 5% position through appreciation become an 8% position, unless its prospective return has commensurately improved as well. We've also settled back the maximum position size we're comfortable with to 8 to 9% of the portfolio, from 12 to 13% or higher before the crisis. Michael Weiner, Third Avenue Management. You always want to use your capital as efficiently as possible, and I think we're fairly good at sizing positions based on the revaluation opportunities present. A lot of value investors may buy at $20, buy more at $15, and then won't purchase another share all the way to $40 or $50. We're not afraid to buy on the way up. If the probability of being right has gone up, the probability-adjusted return can improve, even as the share price increases. Alan Fournier, Pennant Capital. We generally expect to hold something for a long time in order to realize the value we believe is there. But one thing I learned from SAC Capital's Steve Cohen is to be sensitive to when the market overappreciates something in the short term and to harvest some of your gains. Markets inevitably react to data points that you don't think are truly relevant. Trading around that is a profit opportunity and helps you better manage risk. Robert Jaffe, Force Capital Management. When I started in the business, a stock might move 25 cents if there was a sound reason. Today, there's too much information out there and people are misusing it. This creates short-term valuation extremes, which you should often act on. Buy and hold doesn't make as much sense when stocks are hitting price objectives quickly. If we buy at $10 with a 2-year objective of $15 and the stock reaches $14 within 2 weeks, we're not doing our job if we don't take money off the table to buy another stock with a 30% discount right away. Robert Olstein, Olstein Capital Management. 2008 was really quite profound for me as an investor. It increased my resolve to hold only companies I deeply believe in, because you never quite know when forces outside of your control set off a tidal wave across markets that shakes everything to its foundation. During a crisis, the less conviction you have about something, the more likely you are to handle it poorly, and the more likely the company in question is vulnerable. I have put forever to rest my long-standing profile of never selling anything ever. I'm over that. One outcome of this exercise has been to more pointedly question the enduring nature of the status quo and not hesitate in reducing portfolio holdings when the uncertainty is too high. Thomas Russo, Gardner Russo & Gardner. Dealing with adversity. A key occupational hazard of the value investor's trade is buying into a beaten-down stock that in relatively short order falls another 20 or 25% in price. As longtime value hunter Robert Olstein of Olstein Capital Management puts it, when you buy on bad news, it often doesn't just stop on a dime. There's usually more bad news before things start to turn. You could probably make 20% a year by tapping into my phone line and shorting my initial buys of every stock. That's how good I am at timing. Discerning between timing mistakes and just plain mistakes when something has gone against you is a top-of-mind issue for most successful investors, says Richard Pezina of Pezina Investment Management. Making the right decisions at these moments adds more value, in my opinion, than the initial buy decision. We're going to make another decision when we're down 25% in a position. Did we just completely blow it? Are we right but the market is just insane? Or is it somewhere in between? I believe the biggest way you add value as an investor is how you behave on those down 25% situations. Sometimes you should buy more, sometimes you should get out, and sometimes you should stay put. I've never actually looked, but we probably hold tight 40% of the time and split 50-50 between buying more and getting out. Richard Pezina, Pezina Investment Management. I'm catching a falling sword in almost every situation I'm in, and I'm trying to figure out if it's falling from the 2nd floor or the 10th floor. But my capital base is big enough and my appetite to stay concentrated strong enough that, if warranted, I can patiently, over the course of 3 to 6 months, make the price bottom by buying a little stock every day, even as it's going down. Jeffrey Ubben, Value Act Capital. When a stock moves sharply after an earnings announcement, the question I want the analyst to answer is whether something in today's earnings report impacted the value of the company in 2015. Are we 3 years from now going to look back at today's earnings as a seminal moment in our understanding of the business and its competitive dynamics? That can be the case, but more often than not, what's perceived as a bad quarter doesn't impact the value of the enterprise. That often means adding to existing positions. Win Murray, Harris Associates. My threshold for pain is high as long as I believe I'm still right. Historically, we've made a lot more money on the long side when what we thought we were buying cheap went down another 30% before finally going up. We always buy more if our thesis hasn't changed. Francois Parento, Defense Capital. During difficult periods, we have always been willing to add risk as the rest of the market is removing it by reducing valuations. I remember sitting in my office on October 19, 1987, when the market was crashing and getting a call from Royce & Associates founder Chuck Royce, who was one of my brokerage clients then, asking me what stocks I liked and why. I walked him quickly through 3 or 4 of my best ideas. He asked a few questions that made it obvious he knew these companies at least as well as I did, and then told me to put in orders to buy 10,000 shares of each, with additional buy orders of 10,000 shares for every 1/8 of a point tick down in the price. You can only show that kind of resolve with great conviction in your process and your discipline, which increases every time you come through a tough period successfully. It's that process and discipline that is fully under our control. In the end, that's all you should really worry about. Whitney George, Royce & Associates. We're a long-term, low-turnover manager, so the office routine doesn't change much in bad markets. Outside the office may be a different story, say with respect to sleep patterns and eating habits, but we always say, when the going gets tough, the tough do research. One of my biggest jobs is to keep everyone focused. Don't stare at the red numbers on the screen. Call companies, call industry contacts to hear what's really going on. Dig for new ideas, and just look to take advantage of the volatility. Jeffrey Bronchick, Reed, Connor, and Birdwell. My mistake in 2009 was that in March, when I should have been buying, I felt things were completely unraveling and started selling my longs and increasing my shorts. I've spent my career trying to think only for myself, and in this instance I was so influenced by the external world that I blew it with the type of market call I rarely make. All I wanted to do was take risk off the table, when what I should have done was cancel my Bloomberg subscription and focus on the businesses of the companies we owned. That would have been a far better use of my time. Carlo Canal, Canal Capital. It's the bias of the information age that people feel isolated when they're not in touch with what's going on. To me, it's a good discipline to often say, I don't really care what goes on in the market today. When you do that, you can actually get something useful done. Even something simple like saying you'll only answer emails in the morning, at lunch, and at the end of the day sometimes can go a long way toward avoiding unhelpful distractions that tend to arise. We're very big on what we call battle plans, in which we map out how we'll behave at various price points in the market. John Templeton used to talk often about taking that kind of pre-commitment down to the level of individual securities. Because you've already decided what you should be doing, it allows you to focus your attention in a very useful way when the market is falling to pieces. James Montier, GMO. We have periodic devil's advocate reviews of all our large holdings, and a separate analyst is charged with presenting the negative case. It's more than a debate society. The devil's advocate should genuinely believe the negative argument is the right one. We obviously make plenty of mistakes, but that discipline helps us reduce the frequency and severity of them. In investing, that's half the battle. Edward Studzinski, Harris Associates. If an individual position decreases by 10% from our cost, we conduct a formal review. The focus is on understanding why something has gone down. If the reason is that the sector is down or pessimism over a short-term trend has increased, we'll typically buy more if we believe the story is still intact. If the reason the stock is down makes our thesis wrong, we'll sell. What happens more than I think people are willing to admit is that we have no real idea why the stock is down, which is a problem. There's no pat answer for those situations, but we're apt to sell when that happens as well. Christopher Grisanti, Grisanti, Brown and Partners. A guideline that's helped us control risk is to require a full reassessment of our investment thesis when we've marked down a company's intrinsic value by roughly 15% or more. If you have to mark down intrinsic value, you probably made a mistake somewhere. The question is whether what caused the mistake is long or temporary, which deserves a fresh look. Steve Morrow, New South Capital. We have a rigid rule that if a position is down at least 15% from our cost, we force ourselves to either buy more or sell. Human nature in such situations is just to hold. But if our conviction on the idea is intact, we're happy to see it down 15% so we can buy more. If that isn't the case, we'll sell. The down 15% positions in a portfolio aren't great, but they're manageable. What we want to avoid are the down 15% ones that turn into down 40% ones. That's where you really start to blow a hole in your capital that's hard to get out of. Joe Wolf, RS Investments. For stocks going against us, we also have 3 triggers that force a decision. If a stock moves 20% or more against us on a trailing 45-day basis, if a long costs us 25 basis points in a month, or if a short costs us 15 basis points in a month. It's almost never a surprise when something gets flagged, but we force ourselves to decide whether this is a great opportunity or whether we've made a mistake and should move on. The majority of the time we end up adding to the position. Steve Galbraith, Maverick Capital. We don't have many rules, but when a stock is down materially relative to its peer group, we assign another analyst to formally review it and then force ourselves to buy more or get out. Not surprisingly, the analyst who originally recommended the stock is the last person to want to sell it. Jeffrey Bronchick, Reed, Connor, and Birdwell. We have a formal review process if a stock declines by 20% or more from our original point of purchase. The analyst responsible for the idea reviews it fully with the entire team, with everyone focused on identifying what we may have missed. There's no forced action at that point, but if we do decide to average down, we only do so once. Averaging down repeatedly in stocks that are tanking is a great way to destroy a portfolio. Brian Barish, Cambiar Investors. We've done research on all of our buy and sell decisions, and based on 20/20 hindsight, isolated how each one adds or detracts from the overall value of the portfolio. We found that we generally did a good job of selling losers and of holding on to winners. Where we didn't do so well was in buying more of things that were falling in price, which is interesting given how much we as value managers love averaging down. We still have more to learn about this, but I would say we've become even more mindful when looking at whether to buy as something gaps down. Mariko Gordon, Daruma Capital Management. You have to be willing to double down when you invest in the types of companies we invest in, where things often get worse well before they get better. I don't want to leave you with the impression, however, that it always works. In the late 1990s, I had about 12% portfolio position in Superior National, a big player in California workers' compensation insurance. I increased my position in a rights offering, and it got as high as 20% of my portfolio. When the workers' comp business in California fell apart, the company turned out to be too leveraged, and the shares went from $22 to $0. The lesson wasn't not to be aggressive, but not to be overweighted in anything that's so leveraged that it really has the risk of going to $0. Robert Robotti, Robotti & Company. What's the definition of a long-term hold? A short-term buy that went down. James Montier, Société Générale. We're big believers in the notion that losers in this business are the ones who make big mistakes, and winners are those who make small mistakes. For that reason, we try to be unsentimental about our positions, particularly those going against us. We do not average down after a position gets hit, for example. That's counterintuitive to most value investors, but because there is always a fair chance we'll be wrong, we don't want to compound mistakes. One reason I think indexes beat active managers is that you never see an index averaging down. If we've done our job, we can always find another idea that gives us the same potential upside or better, and we'd rather go with that. James Shercliffe, River Road Asset Management. There's an interesting section in Outliers by Malcolm Gladwell, in which he describes how disasters like plane crashes or the 3 Mile Island nuclear accident are rarely because of one big mistake. They're more likely to result from a series of small mistakes, any one of which, if avoided, would have kept the disaster from happening. Many investing mistakes we've made have been in companies where a bunch of little things went wrong, which, when added together, made a big problem. Those types of situations can creep up on you, so I'd say one lesson is not to ignore minor setbacks and to be very aware if they start to pile up. Paul Sonkin, Hummingbird Value Fund. We don't interpret meaning in how stocks are priced. People tend to think if a stock falls 30 to 40%, it must mean things are worse than they realize. We don't think that way, and just stay focused on our estimate of intrinsic value. It can happen that a stock falls 30%, but we think the business value is down 50%, so we sell. More often, the stock price falls 30% and we think the business value may have fallen only 5 to 10%, giving us an opportunity. Chris Welsh, Diamond Hill Investment Group. With investing, focusing on what's already happened is generally a bad strategy. The decision at any point should be only about looking forward. Just adjusting how you set up your spreadsheets and what you track on reports could help in this regard. Dan Ariely, Duke University. If someone has a material piece of information to share about one of our names, I always ask that they first step back and review with me our current shared viewpoint on the stock. That helps us put in context the importance of the new information and to better discuss the extent to which it may alter our conviction and/or target stock price. Someone rushing into my office and blurting out the latest news without putting it into broader perspective increases the possibility we'll make a rash trading judgment. Michael Karsh, Karsh Capital. I honestly don't feel any of the emotional ups and downs from the market's day-to-day activity. I just don't worry about short-term volatility. Ed Wachenheim, Greenhaven Associates. We lost some longtime clients during the crisis, one of which delicately referred to me as a washed-up all-star as the market was going down. It's not possible to avoid it eating at you emotionally when the market is going against you. One critical thing I've learned, however, is that whenever I'm the least bit emotional, I don't make decisions. We can all feel the same emotions as the small investor. When you're in that state of mind, don't do a thing. Robert Olstein, Olstein Capital Management. Sometimes going for a walk or meeting a friend for lunch when the market is down 200 points is a lot better than staring at the screen trying to figure out what to do. You don't have to do anything, and most of the time you shouldn't. I'm absolutely convinced that regularly clearing your mind helps you make better decisions. Aaron Edelheit, Sabre Value Management. Humor is an important part of our culture. That's not to say we're cutting up all the time or that we're even that funny, but in a deadly serious business like ours, if you can't find humor in what you're doing, it's going to kill you. Having a sense of the absurd eases tension and puts things in perspective when things are going against you. Without that, people burn out or tend in their desperation to roll the dice. That's the last thing we want to do. Robert Kleinschmidt, Tocqueville Asset Management. When we buy a stock, we write down exactly why we own it, which we should be able to lay out in 3 or 4 sentences. To the extent those assumptions are no longer valid, we'll sell regardless of how cheap it gets. We're fighting the natural tendency to come up with new reasons to own something, for the simple reason that we found in our post-mortem work on mistakes that one of the best ways to lose money over time is by owning stocks with changing investment rationales. Reagan Steinke, Westwood Management. We tend not to average down. I think it's a common mistake when you don't realize there's something out there you're missing and you compound the problem. We've instituted a soft stop loss that is triggered whenever a position causes a 1% loss on the overall portfolio from cost. Say, a 5% initial position falls 20% from where we bought it. We don't automatically sell, but there's a high bar to keep something in the portfolio, let alone add to it. At the end of the day, markets are too efficient to totally ignore price action. If we're going to be wrong, we usually know in the first year and can cut our losses. Better to admit it then rather than later. Stephen Goddard, The London Company. One thing that helps us maintain perspective through difficult times is that we outline specifically in writing what our investment thesis is and what we expect to happen. If what is happening with the business is in line with our thesis and expectations, that gives us the confidence to stick with something or buy more if the share price tanks. If subsequent events indicate our original thesis is wrong, we make every attempt to ignore the temptation to keep a stock because it's so cheap, or because we can come up with new reasons to own it. That rarely works out well. Edward Marin, Thornburg Investment Management. Our bias toward buying and holding has at times made us too quick to rationalize a problem that hits one of our companies as temporary and already priced into the stock. If the problem turns out to be more long-term and fundamental, it's likely not fully discounted into the current price at all. We've been blind at times to fundamental changes in a company's business because we think the quick 25 to 30% drop in the share price makes the stock too cheap to sell. One technique that helps me avoid this is to regularly look at what we own and ask as objectively as possible if we could buy the exact same portfolio if we were starting over from scratch with the same amount of money. For positions where the answer is probably no, the likely reason is that the company's situation has fundamentally changed, but I just haven't fully admitted it yet. Francois Rachon, Giverny Capital. When something spooks me, I should more often take advantage of the liquidity of the market to get out and finish work on whatever the new issues are. If you determine the problem is a big one, you can avoid a lot of pain. If you conclude the problem is only temporary, you can usually get back in at a lower price. David Eigen, Post Road Capital. I've been at this long enough that I can keep things in perspective. Ben Graham said it well. He said to succeed in the investment business, it helps if you're smart, and it helps if you work hard. But what's most critical to success is that when you have conviction, you stick with it. The fact that you go through times when you're out of sync or out of favor, that's good. You should expect and even welcome it. That's where opportunity comes from. If we'd given up on our conviction in early 2007, betting against financially vulnerable companies, we would have missed a huge opportunity. That we didn't was a game changer for us. Prem Watsa, Fairfax Financial. Taking a stand. Shareholder activism has come a long way from its modern rise in popularity in the 1980s. Back then, says one of today's foremost activist investors, Value Act Capital's Jeffrey Ubben, what passed for activism was little more than buy shares today and tomorrow throw a hissy fit. While that basic strategy has not gone away, more prevalent is a constructive effort over time to influence company management and boards to make changes meant to increase shareholder value. It's not for everyone, and one can certainly be a successful investor without an activist bent, but many of the best investors in the business see their willingness to push for change, when appropriate, as a valuable arrow in their investing quiver. Most shareholders of undermanaged or poorly managed companies vote with their feet rather than push for changes in management, board composition, or strategy. So poor management persists because shareholders aren't willing to do anything about it, which we think is an abdication of responsible ownership and fiduciary duty. But even if big shareholders have a willingness to take on a public company, most firms don't have the experience, resources, or skill set to do so. We think the fact that we have that ability when others don't is a big opportunity. The private equity business was built around taking over companies and doing what shareholders should have gotten done. Most private equity firms do not possess secret sauce in terms of management expertise. They're financial engineers. The amazing thing is that the same shareholders who do nothing to affect change at a poorly managed company before a private equity firm comes in to take over line up to pay a stupid multiple for the company when it comes public again. John Jacobson, Highfields Capital. Michael Price, CEO of Mutual Series from 1988 to 1998, was at the forefront of shareholder activism. His and our attitude became that just selling if you weren't happy wasn't the right conclusion. As the owners of the company, shareholders really deserve full credit for what companies are worth. It's not just our right, it's our obligation to do all we can to see that we get that credit. For us, a continuing dialogue with management, public or not, is an important part of what we do. Peter Langerman, Mutual Series Funds. What we try to do is build high-quality businesses at a price that is not reflective of the intrinsic value of the business as it is, and certainly not reflective of what the intrinsic value would be if it were run better. That allows us to capture a double discount. That's a benefit we can have over private equity. They can buy a company and run it better to exact incremental value, but they're typically paying the highest price in a competitive auction, so they don't get that first discount. We don't control, but because we have a track record of making money for other investors, we can often exert enough influence to make an impact. William Ackman, Pershing Square Capital Management. We absolutely want to be constructively engaged shareholders. We have 10 to 15% of our capital in each of our core companies, so I think it's imperative that we make our views, particularly with respect to capital allocation, clear. For the most part, management appreciates the faith we're placing in their business and in them to get the stock out of the valuation hole it's in. When management is unresponsive, we work to change that. Alexander Ropers, Atlantic Investment Management. The basic reason our investment strategy adds value is that board members are classic agents, not principals. The information board members get about what shareholders want comes from the CEO. However well-intended, board members mostly lack enough fundamental knowledge about the business to challenge the CEO on the performance of the business or new strategies to create value. Almost always, they don't have enough money on the line to have the sense of urgency we have as owners. It's a blueprint for inertia. Jeffrey Ubben, Value Act Capital. We prefer a much quieter form of activism, but every now and then we need to do more. To get on my soapbox for a minute, I'd argue that the unwillingness of institutional investors to take more of a stand against poor management or corporate governance helped contribute to the 2008 crisis. Silence was not the best response to some of the bad behavior going on, particularly in financials. David Winters, Wintergreen Fund. If you think about where the corporate system has fallen down in the U.S., it's when the actual capital has gotten far removed from the enterprise, and the agency relationship between owners and management has gotten so broad and wide. That's when you have disconnects or conflicts of interest. Everything we do tries to shrink the distance between the capital and the enterprise. Activism to a large extent is trying to truncate risk by eliminating the misallocation of capital, which is less likely when those responsible truly act as if they're spending their own money. When making a decision on a new factory or product launch or hiring plan, people should feel the weight of the capital they are entrusted with. Understandably, given the corporate form, many people running corporations don't operate that way. So when that isn't happening, the ability to improve those decisions through activism is a key way to create shareholder value. Michael McConnell, Shamrock Capital Investors. If our capital base were permanent, we'd probably only do active investments, but it isn't. So the fact that I don't ever want to be forced to sell an active investment in the course of an engagement means we also need to hold passive positions. Historically, around 55% of our portfolio has been in active investments, 15% or so has been in cash, and the balance has been passive. The 55% of our capital in activist investments has produced more than 90% of our returns. One primary reason we're working hard to increase the amount of permanent capital we have is to devote as much of the portfolio as possible to active positions. Doing that should enable us to earn higher returns over time. William Ackman, Pershing Square Capital Management. Attracting activists' attention. Value investors frequently zero in on situations in which a company by its own devices has veered off course, resulting in lagging performance that is nonetheless perceived as fixable. Non-activists and activists alike count on fixes being made, with activists looking in varied ways to shoulder more of the load to ensure that happens. Every investor wants to find well-managed companies with defendable market positions that generate a lot of free cash flow that is reinvested intelligently. The problem is, those companies typically don't have valuations we can accept as value investors. So we look for businesses that qualify on a few of the ideal characteristics and that we think can improve on the others. In most cases, either the management is lousy or the company has had a very bad record in terms of capital allocation. To us, those are the easiest things to fix. John Jacobson, Highfields Capital. Our interest starts first with the quality of the business. We're not looking for trouble, for quick deals to be made, for fixes per se, or even for board seats. We buy good businesses at good prices where we're willing to take on the short-term risk, the near-term negative data point, because we think the long-term gain is compelling. If the stock goes up, we look like traditional value investors who made a nice investment. But probably half the time things don't work out that way. We're 18 months in with a full position and the stock is where we bought it, or lower. But we've proved out the industry structure, we've proved out our investment thesis, and we really believe in the asset. It's at that point we go to the board and management and say, we've been your default buyer. We own 5 to 10% of your company and we'd like to buy more, but we won't do so without a board seat. The stock is underperforming. We believe we have a deep understanding of your business. We have a deep knowledge of capital markets, and we want all the information that's available to board members to help craft a strategy that creates value for all shareholders. We don't pick fights, but when the train goes off the track, you need to do something about it. Jeffrey Ubben, ValueAct Capital. Our front-end screening is fairly automated, looking at both performance laggards and where implied expectations are pessimistic. We start with the proposition that the market is right about a company's valuation. If these assets, with this management, with this strategy, in this environment are worth $20 per share, can we identify changes in that composition that would make the market value much higher? More traditional investors might stop there, but we then try to figure out how likely the actions we've identified are to be taken, and over what time frame, and most importantly, how capable we are of helping to make them happen. Ralph Whitworth, Relational Investors. In the typical situation that attracts us, we engage with management in order to try to get them to rein in spending on failing growth initiatives, refocus on the good core business, improve cash flow, and put in place a greater level of discipline with respect to return on invested capital. Jeffrey Smith, Starboard Value. If I learned anything as a management consultant, it was the importance of identifying where a business has its greatest competitive advantage and then focusing the growth and development of the business on that nexus of advantage. Companies consistently lose sight of that for a variety of reasons, often resulting in what we call de-worsification. It's a very common issue for us. People issues are also common. These are very difficult decisions for companies to make, often involving many subjective and emotional variables. When necessary, we try to bring a reasonable and rational approach to difficult situations that need to be made on both hiring and firing. As market time horizons continue to shrink, the patience we'll demonstrate to companies that are disappointing us has been similarly telescoped. We're not rude or abusive, but we are expressing our points of view and building coalitions to drive change earlier, more frequently, and perhaps more forcefully than we have in the past. David Nierenberg, D-Cubed Family Funds. Invariably, the companies we zero in on have poor corporate governance, but we're far more interested in how the board makes decisions than in the tick-the-box governance items like whether they have a poison pill or a staggered board. Not enough boards think of themselves as shareholder representatives. That particularly manifests itself in setting compensation plans, which don't focus enough on return on investment and often just reflect what management wants rather than what true shareholder representatives would require. In virtually all of our companies, compensation is a central topic of discussion. Ralph Whitworth, Relational Investors. Our preference would be to have a constructive conversation with management, leading to a positive resolution. I don't think going immediately for the jugular, as some other activists do, is the best way to succeed. If you embarrass people and attack them personally, you're much less likely to have a rational discussion. But we've made it clear that we aren't going to go away. Phil Goldstein, Bulldog Investors. Activists need the capital base, experience, and credibility to follow through by buying the company or going on the board to help fix it, if steps aren't being taken to address their concerns. You need to be more than a yeller and a screamer whose biggest asset is that you don't care what anybody thinks about you. Jeffrey Ubben, Value Act Capital. There is growing sentiment that a shareholder perspective in the boardroom is helpful, which was not the case 25 years ago. I'd like to think we've moved past the corporate raider phase and that most activism today is done professionally, with the interests of all shareholders in mind. Companies have also increasingly realized how unproductive it is to resist shareholder input. When activists show up, management for the most part behaves responsibly and respectfully. That results in healthy, constructive dialogue about how a company should operate. That type of dialogue is absolutely in the best interest of all shareholders. Jeffrey Smith, Starboard Value. There's a certain trendiness to activism driven by the fact that the opportunities for activism aren't always there. In the 1980s, you heard a lot about it, but then as valuations changed in the 1990s, you didn't hear much about it at all. Now it's popular again, but we've always considered a willingness to be active as just another weapon in our arsenal. Barry Rosenstein, Jana Partners. I will say that I have in the past fallen into what I call time traps, where I've spent too much time trying to resolve problem investments. We will pick our battles, but usually we're better off helping our best investments maximize opportunities than trying to perform brain surgery on dogs. David Nierenberg, D-Cubed Family Funds. One mistake we made with our investment in Borders Group was taking an active role at the company's request. Given the direction the industry was heading and how hard it was to make anything happen, it wasn't worth the time and energy. Paraphrasing Warren Buffett, when you find yourself in a sinking ship, sometimes the best thing to do is switch boats rather than keep bailing. William Ackman, Pershing Square Capital Management. We prefer to avoid public confrontations with management for three main reasons. First, we're a young enough company that I don't want to run the risk of our entire reputation being tied to a public battle with this or that company. Second, we've greatly benefited as investors from forming partnerships with our portfolio companies. We want to maintain that same access, which requires that even when we sit across from management, they understand we're a constructive force and not a potential headache. The third thing is just from a legal perspective. Being an activist is very time-consuming and expensive. Activists are, generally speaking, well-researched and well-informed in their positions, and most of the time are fundamentally right. They may have an issue with the free riders benefiting from their work, but the good ones are doing everyone a service. Larry Robbins, Glenview Capital. I've got a full quota of righteous indignation, and a lot of things turn me off about corporate America, but I've never had the personality for being confrontational. I talk to management at times, both to complain and to offer suggestions, but I'm hesitant to be public or loud about it. If I pushed on an issue and someone called my bluff, I know myself well enough to question whether I'd follow through with a lawsuit or whatever the next step might be. Wally Weitz, Weitz Funds. We like to invest with management that gets it and is doing what we think they should. Some investors want to buy cheap stocks where the businesses are run by morons and then force them to do something different. That's not a bad strategy, but that's not how we tend to do things. Wayne Cooperman, Cobalt Capital. The fact is, when I feel I have to write a letter and make noise, that almost always means I've made a mistake, and the more productive use of my time is to sell and move on. As a buy and hold investor, the perfect outcome is when a company earns high returns on their equity capital for as long as I live. I can hold and have the earnings compound in a tax-efficient way. So, as opposed to agitating for a fight, I'm better off hooking up with people who are great at what they're doing and are going to keep being great at it for a long time. Thomas Gaynor, Markel Corp. Chapter 10. Guarding Against Risk. It's become common practice since the financial crisis for nearly all money managers, and those looking to hire them, to place significant emphasis on portfolio risk management. This renewal of focus on risk is far less pronounced in the best value investors, for the simple reason that guarding against the unexpected has always been at the core of how they think about investing. Oaktree Capital chairman Howard Marks captured the general mindset nicely in this excerpt from one of his many classic investor letters, this one from 2009. Investors shouldn't plan on getting added return without bearing incremental risk, and for doing so, they should demand risk premiums. But at some point in the swing of the pendulum, people usually forget that truth and embrace risk-taking to excess. In short, in bull markets, usually when things have been going well for a while, people tend to say, "Risk is my friend. The more risk I take, the greater my return will be. I'd like more risk, please." The truth is, risk tolerance is antithetical to successful investing. When investors are unworried and risk-tolerant, they buy stocks at high P/E ratios and private companies at high EBITDA multiples, and they pile into bonds despite narrow yield spreads, and into real estate at minimal cap rates. There are few things as risky as the widespread belief that there's no risk, because it's only when investors are suitably risk-averse that prospective returns will incorporate appropriate risk premiums. Hopefully in the future, A, investors will remember to fear risk and demand risk premiums, and B, will continue to be alert for times when they don't. The Baupost Group's Seth Klarman puts it even more succinctly. Things that have never happened before are bound to occur with some regularity. You must always be prepared for the unexpected, including sudden, sharp downward swings in markets and the economy. Whatever adverse scenario you can contemplate, reality can be far worse. Guarding against risk is built into every aspect of the best value investors' strategies, from the ideas they pursue, their buy and sell disciplines, how they build positions, how they structure their portfolios, how they manage cash, and how they hedge. Margin of Safety. In Chapter 20 of The Intelligent Investor, Benjamin Graham, the patron saint of value investing, introduces the concept of margin of safety. Warren Buffett has called this chapter, and another in the same book on responding to market fluctuations, the two most important essays ever written on investing. In its simplest terms, Graham writes that margin of safety comes from a favorable difference between price on the one hand and the indicated or appraised value on the other, adding that it is available for absorbing the effect of miscalculations or worse than average luck. Echoing but also broadening the concept of margin of safety, most top investors today cite the inherent risk aversion they build into how they identify, analyze, and choose potential investments, and of course what they pay for them, as their first and most important line of defense against risk. Our primary frontier of risk management isn't wide diversification, but the quality of the individual businesses, their balance sheets, and the people who run them. In the financial crisis, the businesses we owned held up quite well, even if their stock prices didn't. That type of volatility is risk only if you're looking at a short time frame, which we aren't. Chuck Akre, Akre Capital Management. People don't believe business quality is a hedge, but if your valuation discipline holds and you get the quality of the business right, you can take a 50-year flood, which is what 2008 was, and live to take advantage of it. We incurred a markdown in 2008, and it was arguably just that. You may have to accept a bit more volatility with our fund than in a long-to-short fund, but we followed a down 2008 with a very strong 2009 and 2010, and would put our 3-year returns up against anybody's. The key is avoiding businesses that get snuffed out at the bottom. Jeffrey Ubben, Value Act Capital. Margin of safety comes from as many places as possible, but primarily from the strength and sustainability of the business model, low valuations relative to book value or cash flow multiples, and undervalued hard assets or other assets on the balance sheet. John Jacobson, Highfields Capital. At the heart of value investing is the notion of mean reversion, that by paying a low multiple on a conservative margin, you can win with the passage of time as the valuation of the business and the margins normalize. What can break that and cause mean aversion, though, are things like fading business models, expeditionary management deploying capital in a dilutive way, and adverse capital structure contingencies. We make every effort to invest only in the universe of companies where those risks of breakage are as limited as possible. Matthew McLennan, First Eagle Funds. The consequence of our investment style is that we end up in good businesses, where the market isn't recognizing how good the business is or the level of cash it generates. Those tend to be fairly low beta stocks, so even though we have a relatively concentrated portfolio, with between 15 and 20 longs at any given time, we haven't had very high volatility. Richard Vogel, Alitas Capital. Investing is often about knowing your strengths, and we've learned that we're better at spotting profitable, unglamorous, undervalued companies than we are at identifying traditional turnarounds, by which I mean money-losing companies we expect to get back into the black. As a result, we set a guidance for ourselves that no more than 10% of the portfolio will be in companies with negative trailing 12 months earnings. John Dorfman, Thunderstorm Capital. I've always told people I have no idea what the market's going to do or when returns will appear in the portfolio. I don't think either of those is predictable. The best we can do today is to focus on companies with balance sheets to weather a credit-constrained world, business models that will be around for years to come, and valuations that are cheap enough to make the wait for recovery worthwhile. That's what we can control. The rest of it takes care of itself. Andrew Jones, North Star Partners. Our primary defense against risk, though, is to only buy companies that generate or are about to generate excess free cash flow after capital expenditures and working capital needs. When problems develop, and they will, free cash flow companies don't have to take on short-term strategies that are not in the long-term best interests of the company to survive. They can make strategic acquisitions when others cannot. They can buy back their stock and raise dividends. They also often tend to be the companies that get acquired. Robert Olstein, Olstein Capital Management. Given our number of holdings, 30 to 40, and our low turnover, we can devote 10 times the amount of time some others can spend on any given position, which means we should know the business better, reducing the possibility that things are going to hit us from left field. That depth of knowledge, combined with the quality of the businesses we want to own, is our primary risk management tool. Eric Endy, First Pacific Advisors. Long periods of prosperity tend to breed overconfidence on the part of investors, which leads to a misassessment of risk. During times of excess, we concentrate on reducing risk by holding uniquely strong companies. Ed Wachenheim, Greenhaven Associates. The most important way we manage risk is to avoid situations where credit risks can overwhelm the story. We'll take the risk that our assumptions about the business turn out to be wrong in fact or in timing, but we want to minimize the risk that value is destroyed or the story doesn't even get a chance to play out because of a balance sheet crisis. If you put our portfolios against those of other value managers, we're typically in the lowest decile in terms of aggregate debt-to-equity ratio. Brian Barish, Cambiar Investors. After learning some hard lessons during the first financial crisis, we instituted a rule that any ratio of total assets to shareholders' equity above 2.5 to 1 is an exception, which doesn't automatically mean we won't buy it, but each individual position size will be limited, and we won't ever have more than 10% of the portfolio in such exceptions at one time. That's nothing more than a recognition that when you're wrong with a leveraged business model, the hit to the stock price can just be too fast and too damaging. Robert Olstein, Olstein Capital Management. Building a position. One way savvy long-term investors look to mitigate risk is by being in no rush to establish what they consider a full position in a new idea. That the share price can run away from them before they are fully invested is an irritant most are more than willing to accept. A full position is 8 to 10% of the fund's assets, but we typically work our way there over 3 or 4 tranches. At each step, we're either gaining more confidence in the valuation and our ability to make a difference, or we're not. For example, we generally don't meet with companies until we own a stake, so that's the first step once we've taken a position. As we gauge their response and validate with them and elsewhere how we're looking at valuation, we'll either sell, buy more, or sit on it to gather additional information. Working into positions this way helps manage risk. Ralph Whitworth, Relational Investors. We often take R&D positions in stocks before completely finishing our research. Action adds a sense of urgency to the work. There are so many things to look at in this business that things can fall through the cracks unless you force yourself to focus. Having capital on the books does that. When we find out the company's a bad business partner, there are structural industry issues we didn't know about, or maybe there's an earnings miss we decide isn't a short-term event, then we'll sell. But if every step of the way you get more excited by what you uncover, those are the companies that become 5%, 6%, 7% positions in the portfolio. Ricky Sandler, Eminence Capital. We like to live with smaller investments in a company for 3 to 6 months before making a full commitment. It gives us an opportunity to ever better understand the company and its business, while getting to know the management and whether we're all on the same page. Sometimes the stock pops quickly and the valuation gets too high, or we lose some conviction in the attractiveness of the business, or it becomes clear that management and or the board is not interested in developing a positive relationship. We very infrequently purposely pick a fight, so we'll just move on. Our goal is that by the time we're ready to commit to taking a 10% plus stake in a company, we know the business cold and have bonded with management so that we're really in it together. Jeffrey Ubben, ValueAct Capital. Given that we're often buying into the teeth of a storm, it's rare that we feel we have to establish a full position right away. While some stocks may run away from us, we believe we've been hurt less by that than we've benefited from averaging down as ideas in which we have high conviction first get cheaper, or by adding to positions as our conviction in the business and management grows. Peter Keefe, Avenir Corp. After taking a relatively small position, we'll look to further establish our relationship with the board and management, which should allow us a deeper understanding of both the organization and the business. Management will say the business is going to do this based on how they're managing it, and if that happens, that's helpful, and if it doesn't, that's also interesting. The analytical process is highly iterative, which we consider a key way to manage risk. Jeffrey Ubben, ValueAct Capital. I've never been so disciplined that I hold off buying until 100% of the work is done. A workbench position gets built into a core position only when we have little or no question about the business, people, and reinvestment opportunities. It takes time to learn how the business model really behaves, and I've also found that it usually takes a long time to understand when management is really good. Many of the times I thought I knew right away. I was dead wrong. Chuck Akre, Akre Capital Management. Cash management. How much cash an equity investor can hold in his or her portfolio is often limited by the terms of engagement agreed upon with investors. When that's not the case, opinions still vary widely among top investors on the extent to which cash is a valuable risk mitigator, or even a strategic asset. We don't manage our cash balance in a strategic way. Part of that is a business decision. People hire us because they believe we know how to find great unloved companies, not because we're clever going in and out of cash. Part of it is also just realistic. As much as I'd love to be in cash when the market gets hit, I don't believe I can get that consistently right over time. And if you make just a couple big mistakes on timing, it can kill you. James Shercliffe, River Road Asset Management. By having a high cash balance, one is suggesting that he has some wisdom or knowledge about timing the market for which he or she should be compensated. I have none of that. Carlo Canal, Canal Capital. Many value investors have a very particular view of when things are cheap and when they're expensive and they should hold cash. They portray holding cash as a risk reduction method. My view is that's just taking on a different risk. You're betting there is going to be a regular cyclicality and things are going to get cheap again and you're going to be able to buy them. But if that doesn't happen as you expected, you're screwed. You'll end up like the guys that have been bearish for 20 years and don't have any assets anymore. Bill Miller, Legg Mason Funds. We have opinions on overall risk that impact what we own, but we never have an opinion on the market. I've always found enough companies that meet our standards, so we remain more or less fully invested. I think timing the market is extremely difficult to do profitably. With individual companies, I can pinpoint the relatively few variables I need to get right for a thesis to work. When you start looking at the stock market's direction, there are so many variables that I can't identify them all, let alone predict or weigh them correctly. My time is more productive spent elsewhere. Ed Wachenheim, Greenhaven Associates. People we greatly respect think about this differently, but if even in 2007 we could buy a company like Wrigley at 80 cents on the dollar, we think that's a lot more attractive than holding cash. We were getting a substantial free cash flow coupon, a strong balance sheet with net cash, and bottom line earnings growing at double-digit rates. The way we look at things, even at 80 cents on the dollar, we'd expect a rate of return on something like that in the mid-teens annually. And that was available in, across the board, the priciest market I've ever seen. C.T. Fitzpatrick, Vulcan Value Partners. Our cash balance is purely a residual of whether we're finding enough to invest in. Jean-Marie Eviard, First Eagle Funds. Our willingness to hold cash during fallow periods has enabled us to maintain a strict sell discipline, regardless of whether we had anything promising to replace what we sold. This view on cash, combined with a truly long-term investment perspective, has also enabled us to avoid the gun-to-the-head mentality that pressures many investors to own less than stellar investments. The world doesn't end when we pass on a borderline investment that later works out. The danger we seek to avoid is the temptation or pressure to make too many borderline investments that later turn out badly. Seth Klarman, the Baupost Group. We usually hold less than 20 positions at a time, so no one would ever say we're a place to put all your money, but we behave as if that's what people have done. So we think it's reasonable to have some cash around for emergencies. As Buffett says, why risk what you need for that which you don't need? We used to think having cash was a byproduct of not having enough to do, but the older I get, the more I see it as a strategic asset. It allows us to take advantage of those great opportunities that come up from time to time. We're just behaving like the companies we like to invest in. Bruce Berkowitz, Fairholme Capital. One big reason we like to hold cash is that my inherent nature is to feel something better to buy is always going to come along, and I want to have the cash available to buy it. People assume they can always sell something to buy something better, but I don't like potentially selling into a lousy market when the liquidity isn't there. Stephen Romick, First Pacific Advisors. Ben Graham always made the point that even if you thought you had a portfolio of very cheap stocks, if the market at the time was fully priced, you should have at least 25% of your portfolio in something other than equities, such as cash or bonds. To do otherwise would be to delude yourself that your stocks, no matter how cheap they appeared to you, would be magically immune if the whole market was to correct. I've always thought that made a lot of sense. Charles DeVoe, International Value Advisors. If we can't find undervalued stocks, we'll let cash accumulate, as we believe cash is a better alternative than owning an overvalued security. I'd argue that having the patience and discipline to save your cash for when the fat pitches come along is probably the most valuable trait an investor can have. Eric Cinnamon, Intrepid Capital. Periods of low returns have often historically been accompanied by higher volatility. That scares investors away, but volatility in a low-return world is a blessing for us because there's more opportunity to buy low and sell high. That's one main reason we have 15% of our portfolio in cash, so we can pounce when volatility results in individual stocks being shot down excessively. Charles DeVoe, International Value Advisors. When I was first starting out in the business, you could be more or less fully invested all the time. If there was a downturn in the industrial sector, you could sell the utilities you own that were doing well to buy the beaten-down industrials. In today's market, everything goes up and down at the same time, so you don't have stocks going up to sell in order to buy the bargains. The best way to take advantage of a big market correction, then, is to have cash. In a normal time, we'll keep around 10% cash on hand for liquidity purposes. Given the state of the world today, we're closer to 20%. We'll miss some profits when valuations are running high and we're raising cash. That's just not something we've ever worried about. Dennis Delafield, Delafield Fund. Midas Touch. Holding gold or other precious metals in one's portfolio as a hedge against macroeconomic risks is a common tactic among value investors, one that engenders, however, a good deal of debate. Gold is a logical alternative for those worried about government's ability to manage their finances. If Western political leaders adopt practices which result in devalued currencies, large budget deficits, and rising inflation, gold to us represents a pretty decent store of value relative to currency alternatives. Robert Kleinschmidt, Tocqueville Asset Management. After the financial crisis, we decided we needed to do a little bit more macro investing, hedging for potential strange outcomes within the system. Having a material stake in gold has been one primary way we've done that. David Einhorn, Greenlight Capital. There is a survivalist aspect to having such a big stake in tangible assets. As long as governments show such a low regard for policies that support the real value of paper financial assets, investing in precious metals is about the only way to guarantee the preservation of your wealth. Eric Sprout, Sprout Asset Management. We don't look at gold as a commodity, but as a form of insurance against what Peter Bernstein calls extreme outcomes. In most circumstances in which worldwide equity markets would go down, and not just for a week or two, the price of gold would go up, providing a partial offset to the hits we've taken in our equity portfolio. We don't have a blind commitment to gold. The time may come when we think the insurance premium is too expensive, or we'll decide that the insurance is no longer required. Jean-Marie Eviard, First Eagle Funds. Gold kind of scares me because very often the people involved with it seem to be slightly insane. My other problem is I don't know how to value it. Unlike an equity that supposedly has cash flow attached to it, or unlike a bond that has a coupon, gold isn't worth anything intrinsically beyond what somebody is willing to pay for it. I have ended up buying it, however, because I concluded it offered opportunity under two extreme outcomes. If the world went into deflation, then gold would act as a store of value while the financial system disintegrated. On the other side, we know people use gold as a store of value during inflationary times, particularly in a world in which you're seeing competitive currency devaluations. James Montier, GMO. You could take all the gold that's ever been mined and it would fill a cube 67 feet in each direction. For what that's worth at current gold prices, you could buy all, not some, all, of the farmland in the United States. Plus you could buy 10 ExxonMobils, plus have $1 trillion of walking around money. Or you could have a big cube of metal. Which would you take? Which is going to produce more value? Warren Buffett, as quoted in Fortune. Hedging bets. Beyond more common risk mitigation methods such as diversification, holding cash, and owning gold, there are an ever-increasing number of strategies, under the broadly defined rubric of hedging, that investors can use to guard against general or specific risks in their portfolios. We focus here primarily on one of the more hotly debated of such strategies, the willingness to short individual stocks and indexes. While some market observers and practitioners consider shorting to be the devil's work, others can't imagine their portfolios, or the market in general for that matter, functioning well without it. To short or not to short? Shorting stocks obviously isn't for everyone and brings with it some unique challenges, not the least of which is unlimited risk of loss on any given position. Both avid proponents and opponents of the practice tend to agree on one thing: it's very difficult to do well. Without having a commitment to the short side, it's difficult to be offensive when you should be. The highest return opportunities are available when markets are in free fall, but if you're getting shelled, you may not have the emotional conviction to be aggressively opportunistic, and you may not even be able to do it because of redemptions. Being able to be offensive when everybody else is defensive, in and of itself, can yield excess returns. A second element is that as true committed short sellers, we have to be immensely skeptical, and skepticism is a terrific quality in a value investor. A key reason for our success is that we have a high batting average on the long side. We're better at avoiding mistakes because we're very attuned to those situations where value gets destroyed, or where it isn't really there in the first place, say because of phony accounting. Ricky Sandler, Eminence Capital. Our view is that short selling may not in most years be worth the time and effort you spend on it, but you do it precisely for those years like 2008, when shorting not only offsets on your longs, but also produces capital that allows you to average down on the long side. A lot of people in 2007 gave up on short selling because it hadn't been particularly productive for a few years. In retrospect, that should have been an excellent sign something bad was going to happen. Given all the stylistic differences of value investors, it's easy to forget sometimes what value investing is all about, which I would argue is margin of safety. That margin of safety doesn't just apply to your individual ideas, but also to how your portfolio is put together. The goal should be that in the middle of a storm that puts all the less seaworthy boats at the bottom of the ocean, your boat, battered as it may be, makes it back to shore. Short selling helps you do that. Zeke Ashton, Centaur Capital. Both our shorting and activism have done a good job for us in tempering the downside. No one likes going through a crisis, but our shorts and some activist longs that moved independently of the market in 2008 kept us way ahead of the market and better able to respond to opportunities as they were created. On top of that, I think shorting is intellectually challenging and plays a valuable role in the markets. William Ackman, Pershing Square Capital Management. I believe the irrationality in the market generally tends to be more focused on the long side. As a result, I think that overall there are more incorrectly priced short opportunities than long opportunities. I also just consider shorting to be more intellectually stimulating. Like a lot of things in the markets and in life, the more intellectual argument is usually the negative one. There's something very satisfying about nailing an overpriced security. Robert Jaffe, Force Capital Management. We short because I think it is the most prudent way to manage a portfolio, from a risk perspective, and because I believe the key to successful long-term investing is to avoid losses. We also short because in certain subsections of the market, it's easier than buying stocks. There are always classes of companies that are dying. If you really track the mortality rates of companies, you'd conclude that the market does not have the upward bias everyone thinks it does. The market is actually a carefully pruned garden. Carlo Canal, Canal Capital. We think shorting makes us better analysts. Charlie Munger says you really understand a company when you can articulate the negative scenario better than the person on the other side of the trade. We also think that from a business standpoint, if you've done all the work and conclude the negative scenario is most likely to play out, it makes a lot of sense to be able to short. Rick Dillon, Diamond Hill Investment Group. How would you judge an investing strategy with the following fundamental economic characteristics? 1. Limited potential returns but unlimited potential losses. 2. Skyrocketing competition. 3. Tax inefficiency. 4. Aggregate net losses over its history. 5. The elimination of significant source of income in recent years. 6. risk of asset repossession at creditors' whim. Having spent 15 years of my career doing nothing but short selling, with periods of great prosperity and other periods of fast, painful losses, I can argue with some authority that, as an investment strategy, shorting suffers from each of these characteristics of a bad business. Joseph Feshbach, Joe Feshbach Partners. We dabbled in shorting early on, thinking we should take advantage of the bad companies we uncovered as well as the good. In reviewing our shorts after our first year, we found that in each case we would have made money if we'd actually closed out the positions, but we hadn't. We were good at identifying the short ideas, but were terrible at trading them. Our batting average was just so much better with our longs that we decided we shouldn't devote the time to the shorts. James Vanasek, VN Capital. One general mistake we made in starting our firm was that we told ourselves that we should be hedging against macro concerns when that wasn't really our expertise. Short positions were never going to be a big part of our portfolio, but they took up an inordinate amount of time and added an inordinate amount of stress. James Clark, Clark Bennett, LLC. We do some shorting, but very little. The problem is that shorting requires timing, which isn't my greatest strength. I would guess that for all the shorts we've done over the past 25 years, we're at about $0 profit on them. Robert Olstein, Olstein Capital Management. Value destroyers. Whether one shorts stocks or not, the characteristics short sellers look for in their best ideas are illustrative of what long-only investors should typically take great pains to avoid. The first and most lucrative category of short ideas are the booms that go bust. We had our most success with debt-financed asset bubbles, as opposed to just plain asset bubbles, where there are ticking time bombs in terms of debt needing to be repaid, and where there are a lot of people ahead of the shareholders in the bankruptcy or workout process. The debt-finance distinction is important. It kept us from shorting the internet in the 1990s. That was a valuation bubble more than anything else. The next category involves technological obsolescence. Economists talk quite rightly about the benefits of creative destruction, where new technologies and innovations advance mankind and grow GDPs. But such changes also render whole industries obsolete. Disruptive technologies have two sides and always have. You saw it in the 1980s as personal computers wiped out the word processor and microcomputer markets. What's playing out now is the transformation from an analog to a digital world. While that's created great fortunes like Google's, it's also wiping out whole businesses. Traditional music retailing was one of the first to start going. Then came video rental. Value investors will invest into these types of markets at their peril. Cash flows evaporate faster than you ever dreamed. We also look for accounting irregularities, which can run the gamut from simple overstatement of earnings, often a gray area, to outright fraud. We're trying to find cases where the economic reality is significantly divorced from the accounting presentation of the business. It's not GE managing earnings. Everybody does that. We want to see something way beyond that, where management is going out of its way to mislead. It could be the hiding of losses in offshore subsidiaries like Enron. It could be abusing market-to-market accounting such as Baldwin United and many others did. It could be Boston Chicken, a big winner for us in the 1990s, lending money to franchises to cover losses and not reserving for the receivables. The biggest abuse in accounting today, often legally, is in acquisition accounting. The last big one would be consumer fads. This is when investors, typically retail investors, use recent experience to extrapolate ad infinitum into the future, what is clearly a one-time growth ramp of a product. People are consistently way too optimistic and underestimate just how competitive the U.S. economy is in these types of things. Cabbage Patch Kids in the 1980s, Nordic Track in the early 1990s, George Foreman grills in the early 2000s. James Chanos, Kinnikos Associates. Blue Ridge Capital's John Griffin, one of the few investors who is really good at shorting, says you always want time to be on your side with shorts. Taking that to heart, our primary focus on the short side is on identifying secular problems that over the cycle are working against a given company. We try to steer clear of short positions in businesses that have relatively short business cycles, shorts based on valuation, or shorts betting on a bad earnings release. We often find short ideas when all everyone talks about is how great demand is in an industry, while ignoring the supply side. We've seen that dynamic in some of the component markets for green technology, such as in the light-emitting diode, LED space. With the vast expansion of production capacity we can see going on, good luck making money in this business over time. Lee Atzel, Pennant Capital. We're looking for companies with weakening moats, often coupled with a resulting deployment of capital into areas in which they have no competitive advantage. Even better is when they're deploying not just excess capital, but leveraging the balance sheet to do so. James Crichton, Scout Capital. We don't short on valuation, but rather in situations where we believe a company is violating the law, or has misleading or inaccurate accounting, or has a potential regulatory problem. William Ackman, Pershing Square Capital Management. When we're short, we look for deteriorating industry conditions, company-specific fundamentals at risk, and liquidity issues. We will short a good company, even a cheap company, if we think reality will fall short of current expectations. The best way I've learned to short is by making mistakes on the long side, in value traps for example, and then trying to recognize when others are making the same mistake. Larry Robbins, Glenview Capital. We primarily look for material disconnects between our view of economic earnings and the earnings that are reported and people are using to value the stock. It could be accounting related, so we pay careful attention to things like rising accounts receivable relative to total sales, cash from operations that is not keeping pace with net income, and decreasing returns on capital. We also look for long-term structural declines, kind of the opposite of what we look for on the long side. Wall Street tends not to fundamentally mark stocks down until bad news actually shows up in the numbers. We'll ignore the supposed value today and focus on whether we think the E in a P to E is going to be materially less in 3 to 5 years. Ricky Sandler, Eminence Capital. We focus on what we call false hope, where stated company goals are unlikely or unobtainable. We've had success historically with single-product companies, often in the healthcare field. Management tends to be promotional, the companies burn cash because they're growing so fast, and Wall Street tends to love them because they're always raising money. When expectations appear to be that growth will never stop and that the success with one product will be replicated many times over, there's often plenty of room for ultimate disappointment. Robert Alpert, Atlas Capital. We have a motto: buy cash flow, short cash burn. If a business is burning cash, they're destroying value quarter after quarter. Two things generally happen. They have to recapitalize on unfavorable terms, which is good for us as short sellers, or they can't get financing, which of course is nirvana for us as short sellers because stocks then usually go to zero. Zeke Ashton, Centaur Capital. When there is a cyclone of wealth transfer into an area, some of the participants in the fledgling industry will be real companies whose products and services will change the world. But there will also be dozens of other companies that are bogus and run by unscrupulous promoters. That's the subset of the market we're attracted to on the short side. Carlo Canal, Canal Capital. I have developed something called the C-score, which is basically a 6-variable method for searching out ideal short candidates that are potentially manipulating earnings. The variables are a growing difference between net income and cash flow from operations, increasing days sales outstanding, growing days sales inventory, growing other current assets to revenues, declining depreciation relative to gross property, plant, and equipment, and finally, total asset growth greater than 10%. There's a high probability that companies that score high on those 6 measures are actually manipulating earnings. By also requiring some measure of high valuation, say a price-to-sales ratio greater than 2x, we can imagine stock prices for the remaining companies going south quite fast. James Montier, Société Générale. It's very hard to short good business model, accelerating growth companies just because you believe they're wildly overvalued. You don't often hear of investors making their fortune by shorting something like Google or Amazon. For value investors in particular, it's better to stick on the short side to broken business models, fads, and frauds. There are usually enough of those to go around. Glenn Tongue, T2 Partners. We won't short on valuation, say because Google is trading at 20x next year's cash flow when we think it should only trade at 15x. Stephen Tannenbaum, Golden Tree Asset Management. We're not playing for a multiple reduction or a reversion to the mean for the industry. My biggest mistakes have generally been because I stayed with shorts just because they were expensive. The multiple game is a dangerous one. Valuations can be crazy and stay crazy. We typically want to see something already or soon to be going very wrong. Our best shorts in the past 10 years, in fact, have been more in low multiple companies, where we believed the earnings were illusionary. James Chanos, Kinnikos Associates. One thing we like to do on the short side is to wait to see things start to break down before we get involved. Once something starts to crack, there will still likely be plenty of disagreement, reflected in the stock price, on whether or not the business is really broken. Alan Fournier, Pennant Capital. I guarantee that in every great blow-up there has been at least one big-name investor involved all the way down. Don't stop your work on the downside because you can't imagine so-and-so owner making a mistake. It happens all the time. James Chanos, Kinnikos Associates. Portfolio hedging. While many managers who short view the practice first and foremost as a profit center, shorting individual stocks and indexes can also play an important role in offsetting specific risks elsewhere in the portfolio. Some investors articulate well the strategy behind such efforts, but too often the explication is so complex that more questions are raised than answers given. To give an example of the type of hedging we do, we invested last year in Arkema, a specialty chemical company that was spun out of France's Total. It had all the classic spin-off dynamics, and we saw it as an excellent opportunity to get in at a good price, as a low-margin, neglected company was now going to be run by an independent management that could unlock the business value. At the same time, though, we didn't want to be exposed to a cyclical downturn in the chemicals business, so we shorted a basket of European specialty chemical companies that had twice the margins of Arkema, and were trading at higher valuations. Jeffrey Tannenbaum, Fir Tree Partners. We keep our net exposure to the market at a tight band, usually from 0% to 25%. The basic rationale is that while we're confident in our skill as stock pickers, we're not confident at all in our ability to predict market direction. Another key aspect of our portfolio strategy is to limit exposure to exogenous variables. If we're long a chicken producer we believe is highly undervalued, for example, we'll pair that with a short position on a chicken producer we believe is overvalued, because we don't want exposure to the price volatility of chicken, soybean meal, or corn, commodities that dramatically impact the unit economics of the business. The more we can hedge against exposures that concern us, the more aggressive we can be in individual long positions based on our view of the fundamentals. Tucker Golden, Solis Capital. Our hedging falls into three primary buckets, which vary in emphasis over time. Typically, the biggest one is a global market hedge, in which we use things like index options, index futures, or credit default swaps to insulate the portfolio, to a defined level, from big market dislocations. The second bucket is directly related to what we own, in which we'll hedge against a commodity price, a currency, or another industry player in a relative value trade. In energy, for example, we're usually trying to isolate the relative value between stock prices and commodities futures prices. In those cases, for example, we'll short the oil and gas curve to guard against the long bet getting washed out if commodity prices fall. Another example would be if we own Ford and believe not only that it's absolutely cheap but also cheap relative to GM or BMW, we may short one of those to hedge against a general auto industry decline. The last bucket includes shorts in individual stocks where we're trying to create alpha. It's been increasingly difficult to do this for a lot of technical and competitive reasons, which is why a lot of people have given up on it. We haven't given up, but as a percentage of the hedging we do, it's currently the smallest. John Jacobson, Highfields Capital. Is shorting inherently evil? We don't share the general enmity sometimes directed toward short sellers, as if betting against stocks was somehow anti-American. Well-functioning markets depend on the transparent flow of information, which can be greatly hindered when critics are attacked not for the quality of their analysis, but simply for being skeptics. The vilification of critics, be they short sellers, journalists, or regulators, chills the free flow of ideas and analysis. Indeed, chills free speech by making it so darn expensive, writes Greenlight Capital's David Einhorn in his book, Fooling Some of the People All of the Time, written about his experience shorting Allied Capital stock. If posting an analysis on a website or making a speech gets you an SEC investigation, why bother? As in any category of investors, there may be bad actors who should be held accountable for misdeeds prescribed by law or regulation. There may be bad analysis, for which the market tends to be a strict disciplinarian. Such safeguards should be fully sufficient to punish wrongdoers, while leaving the free flow of information intact. I have no problem with taking a negative view on a company, but as it's gotten easier, through the internet and TV, and more economical, through options markets, to conduct bear raids, there's a much greater risk that short sellers can manipulate the markets and try to bring companies down. Martin Whitman, Third Avenue Management. From our experience, much long-oriented analysis is simplistic, highly optimistic, and sloppy. Short sellers, by going against the long-term tide of economic growth and the short-term swells of public opinion and margin calls, are forced to be crackerjack analysts. Their work product is usually top-notch and needs to be. Short sellers shouldn't be reviled or banned. Most should be celebrated and encouraged. They are the policemen of the financial markets, identifying frauds and cautioning against bubbles. In effect, they protect the unsophisticated from predatory schemes that regulators and enforcement agencies don't seem able to prevent. Seth Klarman, The Baupost Group. One general benefit of shorting is that it tempers volatility in both directions. Risk is created when markets get overvalued, and short sellers help keep that in line. I'd argue that one reason housing got so overvalued is that until very late in the game everyone was on the same side of the trade, which created significant risk in the system. Short sellers also temper volatility on the downside. They're one of the earliest buyers when a stock crashes. I'd also argue that shorts who do good fundamental research play an important watchdog role. They have the resources to dig into something that a regulator might miss. Had people listened to Jim Chanos about Enron, or us about MBIA, or David Einhorn about Lehman Brothers, a lot of people's money could have been saved. William Ackman, Pershing Square Capital Management. It annoys me when management blames short sellers for a variety of ills and then tries to get Congress or the regulators to harass and vilify them. I long for the day when a management team, which has a well-known short seller publicly shorted stock, starts its quarterly earnings call with a Q&A session with the short seller. We are now going to take all questions which Jim Chanos, manager of Kinnikos Associates, who is short our stock, would like to ask. Mr. Chanos, your line is open. Please proceed. Wouldn't that clear the air? Timothy Mullen, VNB Trust. Short selling is now a lot more acceptable than it was, but it's still difficult. People question our motives and say things like, "What's your vested interest? Aren't you saying that just because you expect the stock to go down?" Well, yeah. Don't people who are long say positive things because they think a stock's going to go up? James Chanos, Kinnikos Associates. Chapter 11. Making the Sale. Despite the obvious importance of doing it well, selling often gets relatively short shrift in the discussion of investment strategy. Investors who speak with great clarity and in great detail about their buying strategy often describe their selling discipline in 3 or 4 bullet points. The language used in explaining how, why, and when they sell a stock can be, for want of a better word, fuzzy. This attitude towards selling is consistent with research by behavioral finance expert Terence O'Dean of the University of California, Berkeley, who has found that investors tend to derive considerably more pleasure from buying than they do from selling. Buying is optimistic about what the stock can do for the portfolio going forward, he says. Selling is generally more pessimistic about what the stock has already done to the portfolio, which may or may not have been pleasant. This discomfort around selling is also borne out in research of professional investors' selling practices. As Michael Ervolini, CEO of investment research firm Cabot Research puts it, standard descriptions of the selling discipline typically include 1. We sell when our thesis for the stock has been realized. 2. We sell when the fundamentals significantly change. And 3. We sell opportunistically when we identify better uses of our capital. These are fine reasons for selling a stock, but they don't particularly suggest strategic thinking. This was borne out in a survey of professional investors that my firm, Cabot Research, conducted in 2008 with the CFA Institute. The results highlighted that most sell decisions are based on judgment, feel, and instinct. Less than 15% of the respondents said they used a rigorous and calibrated method for identifying sell candidates. Even the novice investor can attest that selling carries with it more than its share of emotional baggage. This stock has been a dog, but I can't sell now because it's got to be about to turn. This has been a big winner. I love this company. I love this management. How can I sell? Wow, up 30% in 6 months. I better get out while the getting is good. Novice and professional investor alike are subject to the challenges that complicate the selling process. But the best investors tend to place selling front and center among what they must do well, and are adept in articulating why they sell, their disciplines for deciding when they sell, and the lessons they've learned from painful experience. Why to sell? In contemplating selling, investors are dealing with the good, the bad, and the ugly in their portfolios. While that can make generalizations difficult, leading investors are typically clear-headed and thoroughly unsentimental about why any given position should be headed for the chopping block. We sell for 4 primary reasons: when the price reaches our appraised value, when the portfolio's risk-to-return profile can be significantly improved by selling. For example, a business at 80% of its worth for an equally attractive one selling at only 40% of its value. When the future earnings power is impaired by competitive or other threats to the business, or when we were wrong on management and changing the leadership would be too costly or problematic. Mason Hawkins, Southeastern Asset Management. Warren Buffett talks about a company's value moving through innovation, imitation, and then idiocy phases. We're most comfortable in the early stages when we think we're kind of writing the intellectual property. That's not to say there's not a lot of money to be made in the imitation and even idiocy phases, but it's not our native ground. If we're saying the same thing as the consensus and something is no longer misunderstood, chances are we're selling. Adam Weiss, Scout Capital. In general, we own a stock because we have a thesis that we don't believe is widely recognized. Once that thesis is widely recognized, there's no reason for us to own the stock. We hope the stock is selling at a certain level at that point, but sometimes it's higher than we expect and sometimes it's lower. But it's not the price that matters. It's whether the thesis is widely known. If it is, We should be selling regardless of the price. Ed Wachenheim, Greenhaven Associates. Sometimes we sell when we've been right, sometimes we sell when we've been wrong, and sometimes we sell because there are 4 more things that became more compelling. There's a common expectation that people who do primary research in the depth we do to arrive at their own fundamental view of what value is over a 3 to 5 year time horizon should hold the stocks for that long. That can happen, but the reality is it often doesn't work out that way. When we look at our portfolio and feel we have other, fresher ideas more in the early innings of the market's misunderstanding than the middle innings, we will consistently make that swap. Adam Weiss, Scout Capital. We replace portfolio holdings later in their earnings cycle and at the high end of their valuation range with those that have the opposite characteristics. There's not one absolute number against which all ideas are compared. This is the value added of fundamental research, using our judgment and experience to gauge where companies are in their valuation and earnings cycles. Kevin McCreish, Systematic Financial Management. We are fully aware when valuations are getting stretched, which often coincides with a position getting outsized in the portfolio. In those cases, we will likely take money off the table by managing the position size down. Chuck Ockrey, Ockrey Capital Management. We pay attention to what I'd call technical exhaustion points, where the trading experience indicates that the market enthusiasm is so overdone that there's a high likelihood of a reversal. We also keep on top of our companies, industries, and trends to gauge how well the market is understanding the story. We won't put up big returns holding stocks for which the valuation relative to the ongoing potential indicates the story is well understood. John Burbank, Passport Capital. We have for selling what we call the IBD test. When our companies start showing up on Investors Business Daily's Hot Top 10 lists, that's generally the time for us to get out. When the Momentum Investors Bible brands one of our companies as a hot growth company, we're usually ready to sell. Sometimes it's early, but we've gotten in early as well. Cara Denver, D-Cubed Family Funds. To be successful in any business, you have to have a certain competitiveness and a certain paranoia. In our business, where they keep score every day and your problems are staring you in the face, you need to be incredibly focused on the problems in the portfolio and constantly assess whether your analysis is right and the consensus is wrong. There's a fine line between having done your homework and having conviction in it and just being stupidly stubborn. The best investors figure out how to walk that line, recognizing their mistakes and moving on when the situation warrants. All of that is very hard. If it were easy, everyone would be good at it. John Jacobson, Highfields Capital. We try not to have many investing rules, but there is one that has always served us well. If we decide we were wrong about something in terms of why we did it, we exit, period. We never invent new reasons to continue with a position when the original reasons are no longer available. David Einhorn, Greenlight Capital. One general principle I learned from famed hedge fund manager Michael Steinhardt years ago is that if he had a position and there was any discrepancy at all factually or fundamentally from the original thesis, he'd close out the position. You could give him 20 good reasons to stay the course and he wouldn't do it. At first I thought he was just being unreasonable and dogmatic, but I realized it was just about probabilities. He might have in his heart of hearts believed that those 20 reasons were persuasive and he should stay the course, but that wasn't how he thought about things. He was thinking, 90% of the time when something like this happens, I lose money, so I'm going to get out. He wouldn't ever say, this might be the 1 in 10 time it's not going to happen. Brian Jakubowski, Abingdon Capital. It's when we're truly negatively surprised that we typically exit a position. If we're surprised, that usually means management is also, and that there's something more fundamentally wrong with the business than we thought. Steve Galbraith, Maverick Capital. We are required as analysts to present 5, 6, or 7 key reasons to own a stock, and if any of those start to erode, that's a warning sign we regularly track that often leads us to sell. For example, we have tended in the past couple of years to overestimate the intrinsic value growth in media companies. As we scale those estimates back, taking away a primary reason for our owning them, we should be selling. Clyde McGregor, Harris Associates. We are prone to the classic value investor mistake of being stubborn about selling even when the thesis starts to break down. I bought it cheap and now it's even cheaper. I can't sell now. That's complicated by the fact that we're transparent with our investors about what we're doing, and it's hard to admit that what you were arguing last quarter has changed or was flat out wrong. We try to apply a couple basic tests to avoid that mistake. One is to be sensitive that when something is taking up an inordinate amount of mental bandwidth, that's almost always a bad sign. We spent way too much time trying to grapple with AIG in 2008, for example, as the bottom was falling out. Probably the best question we ask ourselves when contemplating selling is, if we didn't own it, would we be buying it today? We bought Lockheed Martin in early 2010 because we liked the hard-to-replicate franchise, strong capital discipline, and positive correlation to rising geopolitical tensions. We also thought that defense spending cuts might be less onerous than expected, especially if the Republicans did well in the next election. When Republicans did do well in the midterm elections, defense stocks did little because everyone was talking about across-the-board belt-tightening. When North Korea shelled South Korea, Lockheed shares actually went down over the next week. Those were market signals that we listened to, and when we asked if we'd be buying the shares today, the answer was no. Given that we also had many other things to buy, we sold and moved on quickly. Daniel Bubis, Tetram Capital. Buying bargains is the sweet spot of value investors, although how small a discount one might accept can be subject to debate. Selling is more difficult because it involves securities that are closer to fully priced. As with buying, investors need a discipline for selling. First, sell targets once set should be regularly adjusted to reflect all currently available information. Second, individual investors must consider tax consequences. Third, whether or not an investor is fully invested may influence the urgency of raising cash from a stock holding as it approaches full valuation. The availability of better bargains might also make one a more eager seller. Finally, value investors should completely exit a security by the time it reaches full value. Owning overvalued securities is the realm of speculators. Seth Klarman, The Baupost Group. Selling by the numbers. It's by no means a universal approach, but the selling process can be one of the more rote disciplines investors follow. If X, then we'll sell. X is, unsurprisingly, usually based on valuation. We generally sell at around 90% of our estimate of business value, and we try to be quite disciplined about it. I've never understood why value investors who are very disciplined on the buy side become momentum investors when they sell, saying they'll wait for the market to tell them when it's the right time to sell. It seems to me that if you think your portfolio is being hurt by that last move from fair value to overvalued, that move is greater than what you get by going from 60% of fair value to 90% of fair value and something else, then shouldn't your strategy be to identify names that you've missed that have run up to fair value and buy them for the run to overvalued? Yeah, it's frustrating to sell names and they go up more. But the flip side is you've reinvested that money in something that you feel is more undervalued and should contribute to your returns beyond what you'll get from what you sold early. Bill Nygren, Harris Associates. When the stock price gets within our estimated range for intrinsic value, we're sellers. To my mind, capturing a discount to a conservatively estimated intrinsic value is a far easier proposition than betting on the growth of intrinsic value over time. Someone like Warren Buffett, who has an incredible gift for imagining how a company's business and market develops over time, is going to be much better than I am at seeing the potential for growth. There are exceptions, but I usually leave that part of a stock's upside to people like him. Jim Rommel, Rommel Asset Management. Psychological issues can come into play, but selling strikes me as fairly straightforward. We'll sell any time we conclude our thesis is flawed or risk factors have emerged that make us doubt the probability of return. In ideas that are working out, if we believe the fair value of a stock is a 5% position and trading at $80 is $100, we start staging out as the position size gets larger and the stock price gets closer to fair value. So we might start selling at $90 and be out by $105. We try not to make it much more complicated than that. We have a friend who keeps sending us emails about all the stocks we sold too soon. But you know what? It's okay to give up the risky profit. We kick ourselves when we turn out to be too conservative by selling at the midpoint of our fair value range, but we can live with that. We specialize in getting the low-risk profits. It's okay with us if other people make money on the high-risk profits. Zeke Ashton, Centaur Capital. We try to keep it fairly rigid. When holding hits some combination of 8 times EBITDA, 12 times EBIT, or 15 times forward earnings, we're going to start selling. Given the types of companies we buy, that means the shares are in the top end of their valuation range, and we can't expect enough further upside. Alexander Ropers, Atlantic Investment Management. We have an absolute valuation process, with buy and sell prices for every stock in our portfolio. We think in terms of cap rate, a real estate term which we calculate by dividing our estimate of a company's normalized operating earnings by its enterprise value. We're trying to buy companies at a 15% earnings yield, and we'll be selling when that yield gets to around 8%. At 8%, you're getting into the rarefied zone where growth and momentum investors are still comfortable, but where those who care about value, including potential buyers of the company, aren't so interested. Whitney George, Royce & Associates. When a stock gets 90% of our value estimate, we formally review the fundamentals of the position and our estimates. We also may begin trimming, particularly if the position is large or less liquid. At 100% of estimated value, we are actively trimming the position. If we still have a position when it gets to 110%, we must be out before it gets to 111%. This approach gives us flexibility to let our winners run, but only within the boundaries of our valuation discipline. That's not to say we'll let the whole portfolio sit in fully valued stocks. We keep careful overall track of where our portfolio holdings trade relative to absolute value. The historical range is 65% to 82%, and right now it's around 76%. I'm not doing my job as a portfolio manager if I'm not swapping out stocks, trading closer to estimated value with those trading at much bigger discounts. James Shercliffe, River Road Asset Management. I have a pretty strict rule that if anything changes my perspective on a company so that my earnings estimates fall by more than 15%, I sell. You could legitimately argue a stock is even more attractive if its price falls 25% and your estimates only go down to 15%. But that in many ways turns an offensive thesis into a defensive one, a dynamic I try to avoid. Jed Nussdorf, Soapstone Capital. Tracking insider selling is sometimes not so helpful, but if you do see an insider aggressively selling when the stock is falling, run. There's only one reason somebody does that, and it's not because they're bullish on the stock's prospects. I couldn't care less if you're paying for a new swimming pool or your kid's tuition. You're selling, and you think your stock is overvalued, so why should I own it? Aaron Edelheit, Saber Value Management. Our selling discipline reflects our desire to exit investments when they reach fair value, although we do pay a lot of attention to taxes, which are inexplicably overlooked by a lot of long and short funds. The common wisdom seems to be that you shouldn't let taxes cloud your investment judgment, but that's unrealistic to us given the difference between short and long-term tax rates. We do not like to sell stocks that have worked before owning them for a full year, unless we feel a stock's price exceeds fair value to the extent that the tax benefit of waiting to sell no longer compensates for the risk of a return to fair value, or worse. Tucker Golden, Solis Capital. I arrived at a rigid, quantitative discipline because otherwise I would have no idea how to sell. It struck me that if you let your emotions dictate when to sell, you risk falling in love with the companies that have been doing well and then you ride them too long, and then something goes wrong. I guess I have the classic value mentality. It's instinctual for me to want to sell as things go up, and I start getting nervous. For me, having something systematic that says, this is cheap or this is fairly valued is really, really important. Richard Pazina, Pazina Investment Management. Getting the timing right. Ask investors to reflect on their mistakes, and they frequently cite poor timing, both too early and too late, when it comes to selling. How they come to terms with this timing challenge, and what they do to overcome it, can be highly instructive in understanding their overall investment approach. Given our value bias, we tend to buy early and sell early. Often, in our best investments, the shareholder base changes from value investors to growth at reasonable price or GARP investors, and we miss out as that full transition takes place and the true believers completely take over. I've come to accept that and consider it kind of inevitable with a value discipline. John Jacobson, Highfields Capital. As sensible as a buy and hold strategy is in a bull market, it can be dangerous in a volatile downward trending one. It's a fair criticism that we historically may have held too closely to our aspirational valuation, even after what we considered our proprietary insight had become conventionally held. We're less worried now about the perfect exit and are content with the perfectly good one. David Nierenberg, D-Cubed Family Funds. I more often than not sell too soon. To avoid that, I'm trying to better distinguish between cases in which the rise in the share price is still primarily a function of improving business fundamentals and those where multiple expansion has become most important. A rapidly increasing multiple often means too many people are starting to agree with me, which makes me nervous. Aaron Edelheit, Saber Value Management. We've many times sold way too soon. To try to avoid this, we forced ourselves to look over long periods at where margin and sentiment peaks have been in individual stocks to really vet how high something might reasonably go. Philip Tasho, Tamro Capital. In cases in which we haven't made a mistake or something better hasn't come along, we've evolved our selling strategy somewhat. We used to have a fairly rigid rule that as soon as something went above the market multiple, we'd sell. But we thought we too often were leaving money on the table, so we now use trailing stops. That means if something hits the market multiple on the day it's trading at $61, we'll set a stop to sell, say at $59. If the stock goes up to $63, we'll set the trailing stop at $61, and so on. Hopefully, this allows us to better take advantage of people's willingness to overpay for our shares. John Dorfman, Thunderstorm Capital. In one stock, we sold way too early. Dealing with management was so frustrating that it discombobulated us, and we concluded the situation couldn't be fixed. In fact, we should have stepped back and recognized that the attractiveness of the business would outlast management. Within a year of the old CEO leaving, the stock went from the low teens to $40. We had the conversation at $7 about whether to take a much bigger position and pound the table more with management. We just didn't do it. Don Noon, VN Capital. When management really makes us angry, we put the file in a drawer for a while and just don't do anything. We try not to sell just because we're angry. If you sell when you're angry, you can imagine everybody else who wants to sell that way reaches the point of exasperation at exactly the same time. That's the kind of thing that creates at least a trading bottom. Better to sit on it for some time, and even if you still hate what the company's doing, you're probably going to get a better chance to get out. David Einhorn, Greenlight Capital. We make a clear distinction when selling between compounders and cigar butt stocks. Once the cigar butts come back, you know to get out because they're just going to go down again. With something like Johnson & Johnson, though, you make a judgment call when it hits intrinsic value, based on your confidence in its ability to compound returns and what your alternatives are. Christopher Brown, Tweedy Brown Company. We will sell when events materially threaten return on capital. The discount rate implicit in the stock gets too low because the valuation has gone up, or if I just have a much better idea. But if a company is doing well and continues to earn an attractive return on capital, I'm in no hurry to sell. Murray Stahl, Horizon Asset Management. If we're investing in a competitively advantaged business run by excellent management, we won't go too wrong even if we hold companies trading above our estimate of intrinsic value from time to time. We've owned Morningstar since its IPO, and I can see it one day becoming a $10 billion business. The founder and CEO owns more than half of the company, and for 25 years has run it at every level to maximize long-term returns. Unless something fundamentally changes in that situation, why would we sell? Brian Bears, Bears Capital. Selling for me is rarely about pure valuation. The really good ones are too hard to find. You don't want to part with them lightly. Life experience tells me that if you sell something at $50 and tell yourself you'll get back in if it goes back down to $35, it will go down to $35.01, and the next time you have a serious look it'll be at $300. That hurts. Chuck Akre, Akre Capital Management. When something approaches our price target, we will reassess it carefully, and the decision to sell often has a lot to do with the alternatives we have. We think it's overly bold of us to try to time going in and out of cash, so we're apt to let something we know well run if we don't have something better to buy. Overall, I'd say in my career I've sold too early many more times than I've sold too late. Candace Weir, Paradigm Capital. Based on our research, investors who sell winners and hold losers because they expect the losers to outperform the winners in the future are, on average, mistaken. Terence O'Dean, University of California, Berkeley. Once we take ownership of an idea, whether it's related to politics or sports or investing, a lot of changes take place. We probably fall in love with the idea more than we should. We value it for more than it's worth, and quite often we have trouble letting go of it because we can't stand the idea of its loss. What are you left with then? A rigid and unyielding ideology that can be quite detrimental to clear thought. Dan Ariely, Duke University. Some of our biggest mistakes have been in companies on which we initially made a lot of money, but then got so enamored with the business that we didn't realize when it stopped being relatively special. Not only did we not sell when we should have, we bought more as it started to decline. You start to believe advantaged companies should stay that way forever, but the dynamics of markets often work against that, and we as investors miss that at our peril. What's important is to try to constantly reassess investments as if you're looking at them for the first time. That's not always easy, but we find it helps keep us from falling into the trap of assuming key assumptions are intact when they really aren't. Paul Tanico, Castle Rock Management. Given the importance we often put on management's ability to fix problems, it's inevitable that from time to time we'll fall in love too easily and make excuses for those in charge when the company continues to do poorly. In these cases, my patience works against me, and we tend to ride a stock down until I get disgusted and sell it. Preston Athey, T. Rowe Price. Sale process. Given the many potential pitfalls that attend the selling process, savvy investors often implement guidelines or rules meant to limit those pitfalls' frequency and severity. Forewarned is forearmed. As our positions have gotten larger, we often find ourselves in situations where we can't trade out positions quickly. There have been cases where we own, say, 1 million shares and we think we want to sell, but we can only sell 25,000 shares right away. You could say, why bother, it's only 25,000 shares. But our feeling is that's silly. It might only help solve 2.5% of the problem, but the problem is now 2.5% smaller than it was. We also find that as you begin to exit a position, sometimes the stomach tells you whether you want to keep going, accelerate, or whether it isn't really necessary. David Einhorn, Greenlight Capital. When we worked for Boone Pickens, he taught us that the most successful wildcat oilmen were not the ones who hit the most gushers, but the ones who knew when to plug a dry hole. I think we're disciplined in ignoring sunk costs. We mark our investments to market every day and say, okay, we bought this at $25 and now it's at $12. What does the upside look like with this new investment at $12? If it meets our targets, we'll still own it. If it doesn't, we'll get out. People are afraid to admit to clients that something is a bust, but we're pretty good at just taking our lumps and moving on. Ralph Whitworth, Relational Investors. We go out of our way with our positions not to look at the original price we paid. All of our summary sheets have intrinsic value and closing price. If you wanted to know the price you paid, you'd have to go look it up. Anchoring on your cost, I know from experience, can often cause you to want to take some money off the table and you end up selling too early. On the other side, if you're underwater, the tendency is to want to get some of it back first before selling. But if it's a mistake, obviously, it's better to deal with it earlier rather than later. Brian Jakubowski, Abingdon Capital. The market encourages all kinds of anchoring. The price at which you bought a stock is very vivid in your mind, but in reality you'd be much better off if immediately after the purchase you forgot the price you paid. We also ascribe importance to 52-week highs and lows, but why that? It would make as much sense to look at the highs and lows over 70 weeks or 40 weeks. Dan Ariely, Duke University. One lesson learned after enduring a few too many round trips is to take more of an internal rate of return, IRR focus on when to sell. What is the return potential from today, not I'm holding this until it reaches my target price of X dollars. We'll still ride things up and down, but it's been less frequent since we started thinking more in terms of today's IRR. When we no longer believe something can make us 50% over the next 2 years, we start picking our spots to sell. Robert Leitzow, Lakeway Capital. We constantly evaluate the key investment case elements for each of our holdings and prepare an exception report each week that flags any number of issues. These include when there are material changes in the remaining upside to our target price, when earnings estimates are revised downward, when questions have arisen about any existing catalysts, when new risks appear, or when the stock has been significantly underperforming. We usually have a limited number of reasons for owning a stock, so if any of those reasons change, we want to recognize that early and move on. Jerry Sensor, Institutional Capital, LLC. One thing about our process that I believe helps us when it comes to selling is that we lay out specific milestones in writing that we're counting on to support our thesis. We try to be as specific as possible. Inventory turns are expected to improve by this much by the end of 2010, or gross margin should increase from 82% to 87% within 2 years. Tracking reality against these milestones keeps you from being in denial when something isn't going the right way, and makes cutting it loose easier. Mariko Gordon, Daruma Capital Management. There can be emotional aspects to all these investments, so there's a real benefit to having more than one person making big decisions. Our rule is that our investment committee has to be unanimous in order to buy something, but if any one of the 3 of us wants to sell, we sell it. That way, there's never anything in the portfolio that we're not unanimous on. Ralph Whitworth, Relational Investors. We have 3 people in charge of the portfolio, and we require unanimity on a stock in order to buy, but it's majority rules on selling. The fact is that it's very hard to sell one of your ideas, especially when it's working beautifully. In those cases, it's often been helpful to have 2 more rational partners be able to overrule the most enthusiastic one. Christopher Grisanti, Grisanti Brown & Partners. We have formed, for lack of a better word, a committee, to which any analyst or portfolio manager can call for more immediate action on a holding than is currently being taken. If the committee by majority vote decides a stock should be sold, that decision, if I'm in the minority, overrides me as chairman and chief investment officer. I agreed to that because no one position should ever be overly disruptive, and because sometimes you need a mechanism to check you when you're digging in your heels. At some point in our careers, because of bull markets, we can start to think we're geniuses. I'm old enough now that I'm well over that. James Shercliffe, River Road Asset Management. Part 4. Of Sound Mind. Chapter 12. Of Sound Mind. Value investors have been eager students of, and active contributors to, the increasingly popular field of behavioral finance, which draws from both psychology and economics in an effort to understand the economic decisions human beings make. These are not the fully rational decisions that efficient markets enthusiasts assume, but the messier actual decisions people make that impact market prices and are driven by a variety of social, cognitive, and emotional factors. Behavioral finance looks to understand and explain investors' natural and evolutionarily supported tendencies toward, to name a few, overconfidence, sticking with the herd, panicking in the face of trouble, disliking losses more than they like gains, falling in love with what they own, overweighting more recent information, and craving the big score. Of course, it's one thing to understand how human nature can conspire against rational investment decision-making, and quite another to keep it from happening to you. As Warren Buffett puts it, investing is not a game where the 160 IQ guy beats the guy with the 130 IQ. Rationality is essential when others are making decisions based on short-term greed or fear. That's when the money is made. In fact, many of the strategies, processes, and disciplines articulated throughout this audiobook are meant to help eradicate those irrational and painful "what was I thinking" types of mistakes. Beyond more concrete elements of strategy and tactics, the best investors also emphasize the importance of mindset to their ultimate success. What are common elements of their mindset? They're competitive, they're contrarian, they balance self-confidence with humility, they're inherently curious, they're constantly learning. While such traits may be more innate than learned, and more difficult for the outside observer to assess, they're extremely important in distinguishing the investors who have what it takes from those who don't. Competitive spirit. Over a total of 38 years as a Division I college basketball coach, the late Norm Stewart amassed 728 wins, most of those at his alma mater, the University of Missouri. Known as a tireless recruiter, the first question he would often pose to aspiring high school players was a simple one. Do you love to play? Of course, all said yes, but how they answered was often telling. Stewart explained that he asked out of a conviction that those who don't truly love to play would never have the dedication and drive necessary to compete at the highest levels, regardless of how talented they were. This universal insight certainly holds true for investors. If their love of the game isn't evident, it calls into question their ability to play it well. What other business is as intellectually stimulating as this? Other than maybe intelligence gathering for national security, I don't know of one. If you like winning, there's a scorecard. If you like game theory and trying to logically deduce what's likely to happen, this is a great application for that, and it's very gratifying to be proven correct. Kyle Bass, Heyman Advisors. I'd use the analogy of a professional baseball player. If you think about what would motivate someone to put so much time and energy into doing something as repetitive as playing baseball, you could probably boil it down to three things. It could be they just like the process of playing the game because they're good at it and get a lot of personal validation out of it. It could be because they're very competitive and want to be on the winning team and want to succeed in an objectively measured way. Or it could be they're just in it for the money, to become accomplished in the field and be well compensated for their talent. For me, I enjoy the process of trying to figure out what's going on in the world, and think investing is about as good as it gets in business terms of intellectual stimulation. Second, I'm very competitive, but in the positive sense of trying to improve and always measuring how well I'm doing that. The third part, making money, is not required, but conveniently and pleasantly is a result of being good at the first two. John Burbank, Passport Capital. I love the challenge of investing. For a competitive person, there's nothing better than when you absolutely nail something that no one else was getting. It's also a great business for people who are intellectually curious. I've followed the battery industry for 20 years, but I learned several new things from my conversation earlier today with the president of Exide. It's a new game every day. Why would I do anything else? Candace Weir, Paradigm Capital. When I started the business, I was motivated by being a real competitor. I love to win, and the idea of being in an industry where you keep score and know where you stand every day was highly appealing to me, and in the end seemed inherently fair. John Rogers, Ariel Investments. So many things impact the markets, from history to politics to popular culture, and those elements change day to day. The challenge of working through all that is constantly exciting, and you can see your results on a real-time basis. Tom Perkins, Perkins Investment Management. I love learning about businesses and the intellectual challenge of investing. I'm also intensely competitive about generating great returns. I love that you get a scorecard at the end of the day, and I love to win. Winning to me is looking back after 30 years and saying, wow, look at that track record. These guys did it well and they did it right. That's not to say I'm particularly fond of those days when you feel like an idiot and your numbers make you look like an idiot. But as a competitive person, I wouldn't have it any other way. Ricky Sandler, Eminence Capital. Figuring things out and solving the puzzles is still the most exciting part. It's very fun to think we understand something that it appears most people view differently. Then you get to find out who's right. David Einhorn, Greenlight Capital. There's a big difference between loving to win and hating to lose, which has a lot to do with one's approach to risk. Someone who loves to win is willing to take a lot of risks because the euphoria of winning outweighs the bad outcomes. If you hate to lose, though, any bad outcome is not acceptable. To be a great investor, I think you really have to hate to lose. John Jacobson, Highfields Capital. Investing is a fun game, and you want to find the people who are just smitten with it. I wouldn't say for the best ones that it's about the money. It may fall off the back of the truck, but it's not at all why they play the game. Joel Greenblatt, Gotham Capital. People who are in a good mood are more inclined to try learning new skills, to see things in a broader context, to think of creative solutions to problems, to work well with other people, and to persist instead of giving up. If you were writing a recipe for how to make more money, those are among the first ingredients you would include. Jason Zweig, author, Your Money in Your Brain. I've always considered myself privileged to live the life I do, making a living doing something I enjoy very much. Francisco Garcia Parames, Bestinver Asset Management. My level of competitiveness was important, yes. I always said that when Tiger Management was going, that our employees would have taken a 15 to 20% pay cut if that would have somehow guaranteed us to be number one. That definitely mellows out over time, but I still like winning, which is one reason I've done this same thing for a long time. You can get too much competitiveness, though, and then you're competitive with your subordinates and your superiors, and you're kind of a horse's ass. Julian Robertson, Tiger Management. I did worry when I shut down my main hedge fund in 2000 that I didn't want my tombstone to say he died getting a quote on the yen, as if I had nothing better to do in the middle of the night than that. Julian Robertson, Tiger Management. Independent thought. One of our favorite quotes with clear application to investing is from Spanish-American philosopher George Santayana, who wrote, "Skepticism is the chastity of the intellect, and it is shameful to surrender it too soon or to the first comer." The best investors are without question a skeptical lot, quick to question the status quo or conventional wisdom, and slow to build the conviction necessary to go against either. If you subscribe to the thesis, as I do, that the greatest amount of money is made from having great confidence in contrarian positions, I think you'd find the people who are comfortable taking these positions don't tend to fit in with the mainstream. Going against the grain is clearly not for everyone, and it doesn't tend to help your social life. But to make the really large money in investing, you have to have the guts to make the bets that everyone else is afraid to make. Carlo Canal, Canal Capital. Figuring out what you should do as an investor isn't that difficult. You can read all Warren Buffett has written or said over the years, for example, and basically emulate that. The hard part is to have the discipline and the patience to execute. The bottom line is that to be a good investor, you need only to buy when it's emotionally the hardest, only sell when it's emotionally the hardest, and pretty much do nothing while waiting for market extremes to offer opportunities to do either. That's all incredibly hard. You often don't know you've been right until months or even years later. Most people need more immediate gratification than value investing typically offers up. Steve Leonard, Pacifica Capital. One of the keys to this business is having conviction based on your work that you're right and the rest of the world is wrong. If you don't have that confidence, you'll never buy anything because there's always something that can go wrong. Everyone thought the idea of buying stock in General Growth Properties right before it went bankrupt in the middle of the financial crisis was the stupidest idea they'd ever heard of, and plenty of people said so. The stock was at 35 cents a share, down from $63, and we bought 25% of the company. You can't get much more contrarian than that. William Ackman, Pershing Square Capital Management. Acknowledge the complexity of the world and resist the impression that you easily understand it. People are too quick to accept conventional wisdom because it sounds basically true, and it tends to be reinforced by both their peers and opinion leaders, many of whom have never looked at whether the facts support the received wisdom. It's a basic fact of life that many things everybody knows turn out to be wrong. How can an investor use that? The uncertainty involved in predicting complex events would argue for some level of diversification and a greater focus on hedging. At the same time, the fact that people tend toward overconfidence and follow conventional wisdom should provide an opportunity for those taking contrarian positions against that. The trick, of course, is to have concrete justification for why the crowd is wrong. Robert Schiller, Yale University. As value investors, we're quite used to being short on social acceptance at different periods of time. It's always important to keep in mind that our own balance and equanimity should not be based on external perceptions. Matthew McLennan, First Eagle Funds. You learn quickly in this business that you're not going to look smart all the time, which inevitably brings criticism. We always remind ourselves of that great Jean-Marie Eviard quote, "I'd rather lose clients than lose clients' money." David Samra, Artisan Partners. As it turns out, one of the key lessons of investing is that the best successes are born during times when you're not a winner. I was down 2% in 1999, a year the S&P 500 rose 21%, and it was probably my best year. Nothing worked that year, but resisting the temptation to chase ideas I didn't believe in left me positioned for some of my best years thereafter. It's a long race, not a sprint. If you rely on the market's validation all the time, not only are you going to be very disappointed, you're also going to make a lot of mistakes. Thomas Russo, Gardner, Russo & Gardner. I think our being based in Columbus, Ohio makes it easier for us to be independent thinkers, which is so important to successful investing. When we leave the office, we're not very likely to be influenced by what other investors are talking about because there aren't many out there. I honestly believe that's an advantage. There's no herd mentality because there's no herd. Rick Dillon, Diamond Hill Investments. One reason our results have been relatively strong is because our mistakes have been in smaller positions and our successes in larger ones. I attribute a lot of that to our partnership. I tend to be a glass-half-full person, while Ed, co-manager Edward Studzinski, behaves more as if the glass is broken and empty. He helps restrain my more aggressive instincts, and his natural skepticism has been incredibly valuable. Clyde McGregor, Harris Associates. We tend to be conservative and deliberate, which often keeps us from buying as much as we should as quickly as we should. Having said that, I think being skeptical and wary about all the things that can go wrong is a good way to avoid making a lot of mistakes. Anyway, it's my nature to be that way, and even if I could change it, I wouldn't really want to. Wayne Cooperman, Cobalt Capital. An early mentor of mine, T. Edmund Beck, started out during the Depression and used to always say we were in the rejection business, that we're paid to be cynical and that a big part of success in investing is knowing how to say no. He never dwelled on missed opportunities because something else, even the same thing later on, would always come along. I'm a big believer in that approach. Spencer Davidson, General American Investors. Perpetual Student. Unlike basketball, investing is a game at which you should become more proficient with the long passage of time. This can only happen, however, with the mindset of a perpetual student, as conversant in historical precedent as you are in future possibility. The nice thing about investing is that if you can protect your physical and mental health, you should only get better at it over time. Experience improves your ability to recognize patterns and to exercise judgment in difficult situations, of which there have certainly been no shortage in recent years. David Nirenberg, D-Cubed Family Funds. I enjoy being a perpetual student and working with good people. I'll probably be here until I go non compos mentis. I'll lose my marbles. Then they have a right to get rid of me. Martin Whitman, Third Avenue Management. I generally find the best investors are very open and have almost a childlike curiosity about how everything works. They don't come to the table with preconceived notions. Americans, in fact, are more likely to have this kind of attitude than Europeans or Asians. It's much harder to learn new things when you think you already know everything. Oliver Kratz, Deutsche Asset Management. Soon after graduating from college, I went through some testing at the Johnson O'Connor Institute and found that I have two prominent aptitudes: inductive reasoning and what they call ideaphoria. These don't often go together. One involves a logical progression from specific observations to arriving at broader generalizations, while the other is an unusually high-frequency flow of ideas, many of which are unfocused and nonlinear. You don't want much ideaphoria if you're an accountant, but those two aptitudes combined seem to be conducive to investing. Carlo Canal, Canal Capital. Fortune magazine recently had an interesting article about how successful people work, and one of the people they spoke with was Wynton Marsalis, the great jazz trumpeter. He said that if you want to be able to find a groove, you have to practice, practice, practice. You've got to know the scales, and you've got to know the basics if you want to improvise. Mitchell Julis, Canyon Capital. Things trade at different values from their true worth because human beings look at them in certain ways in certain circumstances. Those ways and circumstances can change, so the tools you use and your thought processes have to evolve. The exact same thing doesn't always work over and over again. The market's too smart for that. Lisa Rapuano, Matador Capital Management. One of the things about which we're institutionally most proud is having outperformed the S&P 500 in every rolling 10-year period since 1969. That means we've had to be open to change and not just do exactly what had worked for the previous 10 years, because the best funds in any 10-year period are always the funds optimized to that period, in healthcare, say, or commodities or technology. The biggest risk we worry about is not adapting to the times and participating in change. That's what keeps us on our toes. Christopher Davis, Davis Advisors. I'm a golfer, and one of the things I love about it is that you can play the same course 20 days in a row and every day will be different. It just rained, or it's hot, or the wind is blowing from a different direction. You have to adjust all the time for a lot of changing factors, which is also true of investing. People who really love to invest wouldn't have it any other way. Robert Lightsoe, Lakeway Capital. I've had the good fortune of being around smart investors my whole life, including my father. Because of that, I'm sure things maybe clicked a bit more quickly when I started getting interested in investing. But I'd have to say, learning from what works and what doesn't is how you really become a better investor. In the end, the market is the best teacher. Wayne Cooperman, Cobalt Capital. You have to have your eyes open all the time and devote yourself, as Charlie Munger says, to lifetime learning. As I like to say, in life as well as in business, I'm lucky if I've learned something new every day, and I'm doubly lucky if it didn't cost too much to do so. Chuck Akre, Akre Capital Management. Will Rogers once said, "Good judgment comes from experience, and a lot of that comes from bad judgment." I add to my base of experience every day. Donald Yachtman, Yachtman Asset Management. One great thing about investing is that, unlike the pitcher who starts to lose his fastball in his mid-30s, my fastball as an investor should keep getting better. I'm one of those guys who says, "Thank God it's Monday," because this is as much my hobby as it is how I make a living. If you don't feel that way, you should probably be doing something else. Andrew Pillara, RS Investments. To err is human. Critical to the learning process is a rigorous assessment of how and why past mistakes were made. No portfolio manager would admit that he or she makes little effort to learn from mistakes, but we have often found in this regard that words often don't match deeds. Money managers expect executives of the companies whose stocks they own to be open and honest about mistakes, to be quick to correct them, and to be diligent in trying to make sure they don't happen again. Investors should expect nothing less from those to whom they have entrusted their money. We have a deliberate process to at least once a year sit down and look at the mistakes we've made. If you do it too often, you probably don't achieve much at all because you're constantly looking over things before the mistake is actually clear. We try to focus more on process errors we can control than just on what went wrong in terms of outcomes. It's also important to make sure you learn the right lessons. It's very easy to learn a specific lesson that isn't very helpful because you won't find yourself in exactly that specific situation again. You want to learn the most general lesson you can from the mistakes you make. James Montier, GMO. I'm playing golf in a foursome that includes someone who's a terrific golfer. He's teeing off and takes a big swing and misses, digging up a divot off to the side of the ball and tee. He regroups, takes a deep breath, and then does the exact same thing again, digging an even bigger divot in the same place. He looks at his caddy, who walks over and takes the ball and tee and puts it into the divot hole and says, "Try this." I thought that was hilarious, but it gets to the importance of working hard to not repeat mistakes. We set up our processes so that we're formally addressing as many of the answers as possible to the question, if it turns out 2 years from now we've made a mistake, why would that be? It obviously doesn't eliminate all mistakes, but for a concentrated manager, if as a result you only make 2 material mistakes per year rather than 4, that can make a huge difference in your performance. Jeffrey Bronchick, Cove Street Capital. We do postmortems on all of our positions, as well as regular position reviews of what we own, to constantly assess what we got right and what we didn't. That matters because we want to learn from mistakes even if the investment outcome turned out to be fine because we were lucky. Luck is not a sustainable way to make money as an investor. Avoiding mistakes that you've made before is. One primary virtue of experience is that you're constantly learning the ways in which things can go wrong. If you internalize that into your process, you're identifying more of what can go wrong and assessing how that changes your investment case. Minimizing the number of times you get blindsided is a very worthy goal. Sean Kravitz, Esplanade Capital. Some investors don't want to dwell on their mistakes, but we closely track over rolling 5-year periods how all of our buy and sell decisions are working out. In the same way we don't beat ourselves up for missing something that truly couldn't have been seen in advance, we don't want to take comfort when an investment works out, but our analysis was wrong. Rick Dillon, Diamond Hill Investments. Mistakes of judgment are the toughest to learn from because each one is different. They tend to be in companies in which there has been gradual degradation, hard to pick up from the outside, either in the competitive landscape or the culture of the company. Because each case is different, it's hard to draw general lessons, and you don't want to learn the wrong one. There were a lot of ways to look at the mistake of buying AT&T when Michael Armstrong took over. Successful executive from outside the industry that would have prevented you from buying IBM when Lou Gerstner came in. Christopher Davis, Davis Advisors. I did a simulation on how often a top money manager earning 20% per year with a 15% standard deviation would lose money over short periods. A 20% return would be about double the market's long-term average return, and a 15% standard deviation would be lower than historic market volatility. So this is someone who's doing very well. But on any given day, this hypothetical manager would lose money almost half the time. He'd lose money in 35% of the months and in an average of 1 quarter per year. Once every 10 years, he'd have a losing year. I think it's healthy for investors to remember that even great long-term records are full of plenty of down months and quarters. Remembering that is hard to do sometimes, as time horizons in the industry have gotten so short. Brian Jakubowski, Abingdon Capital. My time playing golf taught me some useful lessons as an investor. For one, you make mistakes all the time and you try to learn from them, but it's always about the next shot. It's about properly preparing and then executing to the best of your ability. That's an excellent mindset for an investor to have. Pat English, Fiduciary Management Incorporated. I've been doing this for more than 25 years and I've learned never to take mistakes lightly. What's most important for us, though, is to stay focused on the discipline of only investing in companies with the characteristics of leaders, laggards, and innovators that we've seen work as investments over a long period of time. That discipline keeps us grounded and helps us keep mistakes in perspective. Otherwise, you can drive yourself crazy. Philip Tasho, Tamro Capital. Don't be paralyzed by the fear of making a mistake. Understand that the best opportunities usually carry more perceived risks, and distinguish carefully between the risks that matter most and those you can live with. As long as I know the risks I'm taking and the stock prices are compensating me to take those risks, I can live with that. Brian Gaines, Springhouse Capital. You want to make mistakes every once in a while. If you never make a mistake, you're being too conservative and missing profit opportunities you shouldn't. Ed Wackenheim, Greenhaven Associates. Be ever so humble. There's no question confidence in one's abilities is critical to successful investing. To commit one's own and others' hard-earned capital requires conviction, and conviction requires confidence. But as with fine scotch or pepperoni pizza, too much of a good thing can cause problems. It can at times be difficult to see, but quite often, even the most accomplished money managers exhibit a level of humility about their craft that, far from a sign of weakness, is often a prerequisite to long-term success. One can see the investment universe as full of certainties, or one can see it as replete with probabilities. Those who reflect and hesitate make far less in a bull market, but those who never question themselves get obliterated when the bear market comes. In investing, certainty can be a serious problem because it causes one not to reassess flawed conclusions. Nobody can know all the facts. Instead, one must rely on shreds of evidence, kernels of truth, and what one suspects to be true but cannot prove. Seth Klarman, The Baupost Group. You obviously need to develop strong opinions and to have the conviction to stick with them when you believe you're right, even when everybody else may think you're an idiot. But where I've seen ego get in the way is by not always being open to question and to input that could change your mind. If you can't ever admit you're wrong, you're more likely to hang on to your losers and sell your winners, which is not a recipe for success. Kyle Bass, Heyman Advisors. It is much harder psychologically to be unsure than to be sure. Certainty builds confidence, and confidence reinforces certainty. Yet being overly certain in an uncertain, protean, and ultimately unknowable world is hazardous for investors. To be sure, uncertainty breeds doubt, which can be paralyzing. But uncertainty also motivates diligence, as one pursues the unattainable goal of eliminating all doubt. Unlike premature or false certainty, which induces flawed analysis and failed judgments, a healthy uncertainty drives the quest for justifiable conviction. Seth Klarman, The Baupost Group. When I worked for New York City, I met an old-time surveyor in my department who had gone broke betting on horses. The first time he had gone to the racetrack, he decided to bet on a horse named Surveyor, and the worst possible thing happened. The horse won. This guy figured it was easy money, and over the next 20 years he proceeded to lose just about everything he had. People forget it all the time, but it's important as investors to differentiate between luck and skill. Over short periods of time, you can do the wrong thing and make a lot of money, and do the right thing and look like an idiot. We try to stick to what we do well and not get too caught up in what's working at any given moment. In the long run, that sort of discipline will keep you from blowing up. It's a lesson a lot of smarter guys than us have obviously forgotten. Phil Goldstein, Bulldog Investors. Whatever the environment, we try to remain humble, which means maintaining our discipline of buying only great companies with strong balance sheets when they're priced with a wide margin of safety. It's when you're not humble that you end up doing things that will make you humble. Francois Rochon, Giverny Capital. Over a long career, you learn a certain humility and are quicker to attribute success to luck rather than to your own brilliance. I think that makes you a better investor because you're less apt to make the big mistake, and you're probably quicker to capitalize on good fortune when it shines upon you. Spencer Davidson, General American Investors. We know our investors are going to worry about their portfolios over short time periods, but we explain to them that we won't. We try to look at short-term market gyrations as nothing more than opportunities to smartly enter or exit a position, subject to valuation and fundamentals. While I hope that keeps us rational, I wouldn't say I am always calm. My style at heart is out of the pages of Andy Grove's book, Only the Paranoid Survive. When our stocks are going down, I'm driving everyone nuts to see what we might be missing. When our stocks are going up, I'm not any more comfortable. I'm worried whether they're going up for the right reasons and how it might all come crashing down. I say we invest paranoid somewhat tongue-in-cheek because we couldn't take the sizable positions we do if we were truly paranoid. I just worry about it every step of the way. Stephen Romick, First Pacific Advisors. I've seen too many businesses, investment firms and others, run into the ground by impressive people who start to think they're smarter than everyone else. That's when big mistakes get made. There are enough ways to screw up in this business without bringing it on yourself because of ego. Barry Rosenstein, Jaina Partners. Attempting to achieve a superior long-term record by stringing together a run of top decile years is unlikely to succeed. Rather, striving to do a little better than average every year, and through discipline to have highly superior relative results in bad times, is 1. Less likely to produce extreme volatility, 2. Less likely to produce huge losses which can't be recouped, and 3. Most importantly, more likely to work. Howard Marks, Oaktree Capital. This is the world's best business when you're doing well, and somewhat less so when everybody's yelling at you because you're trailing the market. It's important not to get carried away with yourself when times are good, and to be able to admit your mistakes and move on when they're not so good. If you are intellectually honest and not afraid to be visibly and sometimes painfully judged by your peers, investing is not work, it's fun. Jeffrey Bronchick, Reed, Connor, and Birdwell. The final word. Value investors have a long tradition of sharing what they've learned, which we hope to have honored by assembling the insights many of the best money managers in the business have shared with us over the years. We have gone to great lengths to make sure that their words, not ours, have taken the most prominence. Our greatest wish is that you'll find in the wisdom they've imparted insights that will make you a better investor tomorrow, a year from now, and 10 years from now. To that end, it's only fitting that we close with the quote we used to lead off our editor's letter in the inaugural issue of Value Investor Insight, from Warren Buffett's longtime partner and brilliant investor in his own right, Charlie Munger. If Warren Buffett had never learned anything new after graduating from Columbia Business School, Berkshire Hathaway would be a pale shadow of its present self. Warren would have gotten rich. What he learned from Ben Graham at Columbia was enough to make anybody rich. But he wouldn't have had the kind of enterprise Berkshire is if he hadn't kept learning. I don't know anyone who became a great investor with great rapidity. The game is to keep learning. If you don't keep learning, other people will pass you by. Here's wishing you a lifetime of investing pleasure and prosperity at the front of the pack.